End up, though the majority still think it's going to be 50 basis points from 75 come December. But it is the China story, as Francine was saying, that pivot that has come through in the last 24, 48 hours with concrete measures in some of those major cities. And of course, the implications across the commodity space. But you're seeing that rally again, mainland shares, but also in Hong Kong, particularly with those tech names listed over in Hong Kong. We'll break that down for you shortly. Across the open here in Europe, then the Spanish IBEX currently down 0.1%, the French CAC off by 13 points. And here in the UK, the FTSE 100 currently range bound. Let's change it up then and see how these cross assets and the future stateside are shaping up after, of course, a bit of modest, some of the headwinds, at least tailwinds, for those US equities taken out by that strong jobs numbers on Friday. The future's pointing low by 0.3%. The pound, look at that, 122, not far off 123, where it was earlier in the session. Further upside, that is largely tied to softness in the US dollar. Interesting at times when you hear the likes of the CBI coming out and warning about the need for a growth plan here in the UK. The 10-year stateside 352, that's a move of around 4 basis points. You saw, of course, yields rally on Friday on the back of those NFPs. And Brent, $85 a barrel, up 0.4%. Multiple different cross wins for, of course, oil, given OPEC Plus holding. And then, of course, the news around the price cap and tying into that, China reopening, to some extent at least. Let's have a look at Chinese assets then on the back of some of the measures that have been put in place in the last couple of days. The CSI 300, the benchmark, up about 10% in the last 30 days or so. Of course, year-to-date still lower, but today the session gaining once again for the benchmark in China, up 2%. The Hang Seng over in Hong Kong gaining 4.5%, but it's the tech stocks that are really driving this rally. And I had to do a double take because this benchmark is actually up around 50% in the last month or so. 4,237 is what you're seeing on the HS Tech, currently up just over 9%. And the yuan as well, gaining back below 7 on the yuan, 696, strengthening again 1.3%. Look at that for the Chinese currency. Francine.
Tom, let's dig deeper into some of the sectors. You're absolutely right. A lot is happening in technology stocks. I feel bad for wearing actually a red suit because it is permeating. So industrial staples, healthcare on the downside, they're not huge losses. They're down around 0.2%. Overall, you can see the S&P 600 down 0.1%. So it's just a little bit tentative. We did have, as Tom was saying, encouraging news out of China. And you also had that U.S. jobs number, which could reprice or could have an effect on what the Fed does. In terms of some of the gainers, I'm seeing a couple in materials after OPEC Plus didn't decide to do much, so we keep on looking at energy and others, including financials, Tom.
Okay, let's bring it back then to the Chinese currency. The offshore yuan strengthening through the closely watched 7 per dollar level for the first time in nearly 3 months as authorities accelerated a shift towards reopening the economy. Let's bring in Bloomberg's Sophia Horta-Acosta for more on the market reaction. Sophia, the rally on the mainland, but also there in Hong Kong, has been remarkable. There's an expectation that it can continue as China pushes through some of these easing measures around COVID-0.
Good morning, Tom. I'm going to go out on a whim and say this is the biggest macro story heading into next year. Forget about the Fed. It's all about China reopening, and that's playing out in the currency. Some kind of headwinds around that. Obviously, consumption remains weak, and there's still a lot that we can say about the dollar. But really playing out in the Hong Kong equity space. You mentioned the Hang Seng Tech Index. What does this have to do with reopening? It doesn't. This is all sentiment, flow-driven. This was an index that was down more than 70% since its peak. And I really want to point out as well that Morgan Stanley's equity strategy team, and why do we care about them? Because they were right in February 2021, when everybody was still bullish on Hong Kong stocks and Chinese stocks. They said they turned cautious, and today they turned bullish on the on Hang Seng Tech. On Hong Kong stocks. I'm jumbling my words there. Hong Kong stocks for the first time since February 2021. And that is a very, very big call. They were the last remaining bears, and really, really showing the optimism that's building in the market. And yes, to answer your question, there is a sense that it will continue. Maybe not on the yuan, but definitely in the equity space.
Sophia, thank you so much. As always, Sophia Horta-Acosta. There was some wonderful analysis, of course, on what's going on with some of the Asian stocks. Now, we're also getting Credit Suisse. They're just opening. They're actually extending some of the rally that started on Friday. They're climbing some 3% at the open. And then separately to that, we heard in the media that actually the Crown Prince of Saudi Arabia could get a stake, or certainly could put some investments into Credit Suisse First Boston. So this is the arm that they're trying to, if not spin off, certainly put to one side. Now, we're joined by Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments. Hannah, good morning. When you look at everything that's happened, we'll get to Hannah actually in just a second, but there's been a lot going on in general because of what we heard from the jobs. So that was Friday, then a couple of things on, of course, China, and then we had oil over the weekend as well.
A huge couple of days, a huge 24 hours, 48 hours for these markets as investors kind of weigh up how to navigate. And as Sophia Horta-Acosta in Hong Kong was saying, and that was her call, China is going to be the big macro story of next year, not the Fed. So that is it's a clear call from our team in Hong Kong. And as you said, Morgan Stanley turning positive, bullish on Chinese stocks after being bearish in 2021, Francine.
Now, let's get straight to Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments. Hannah, great to see you. We had the jobs report on Friday. Today we have reopening in China. Where do you want to put your money?
I think it's so exciting, the moves we've seen in the market. I mean, if you look at China over the last month, it's 30% move last month. We're up again strongly today. I think that where we've come from, given the dramatic sell-off we had in China, there are still pockets of value there, and it's still starting to look really exciting now that the sentiment has improved, certainly in comparison to some areas of the US. It's real valuation dispersions. I think it's a real environment for careful stock selection, and we're starting to see some real exciting pockets of opportunity.
Do you want direct exposure then to Chinese stocks, or do you want to play it via, for example, European corporates with that footprint in China? How do you want to get exposure?
I think the European corporates that have exposure in China are looking actually very expensive. I think we've already seen quite a lot of move there. If we look at companies like L'Oreal or LVMH, for example, they've had an exceptional move up over the last few weeks, particularly on that reopening news with China. And I think that your valuations are actually much better, the starting point in China still for that direct exposure, especially if you're starting to look at areas like companies like Tencent in online gaming, for example, NetEase as well. I think the valuations there are just much more compelling than the pockets of quality in Europe that actually have moved up already ahead of the news flow.
So how do you play that?
So I think that you can invest directly in China. I think that's still a very good way to do that. So like I said, a company like NetEase with its online gaming exposure has got an exceptional balance sheet, and it's looking to diversify into that international game space. It's got a lot of cash on the balance sheet, very good operating margins, and a very, very good consumer base. So I think that, buying into the areas like that where they've had a very strong move over the last month, but that said, they've come down a long, long way from where they were, say, 2 years ago. So I think that you've still got a good entry point in names like that.
What is the catalyst for EM on the back of the reopening of China? Is this now, are we shaping up for a bull market in EM on the back of this reopening from China?
I think think so. I mean, I think if you look at the valuations, it's really exciting. If you obviously you've got the weakness in the dollar as well, which very much helps. So I think if we look at where we're going for the next year, where the exciting place to be is in those companies that either have the emerging markets exposure, or if you're invested directly in emerging market, a company like Samsung, for example, you've got exceptional entry points in these companies. They've come back a very, very long way from their highs in 2021. If we look at where we were just a year ago, many parts of the investors were calling China emerging markets uninvestable. And so if you were brave enough to put your money into companies that have those structural growth themes, that have the good balance sheets and high quality, you've got an opportunity to make some very good money there, I think.
Anna, you mentioned that actually you liked, a couple of things in Europe. Are you worried? What are you worried about most in Europe? That inflation is still out of control, and so we can't find peak? Is it the energy crisis, or is it structural concerns in certain countries?
I think it's a combination of inflation and the energy crisis has got a bit of a, it's a sort of double whammy for Europe, if you like. And also, I think that many parts of European quality are, like I said, still quite expensive. And so I think one has to be careful in terms of where you're going to go with that. Parts of like L'Oreal, like LVMH are still very, very expensive, I think. They already had their move. I think you've actually got better opportunities in parts of emerging markets and also subsectors of the US, to be honest with you. Sold off spectacularly hard. If you look at areas like medical technology, come back very, very much, and they've got much better runways for growth in the future. So I think Europe, yes, it's got opportunities, but I think you've got to just be mindful of valuations.
Hannah, what was your assessment of the non-farm payrolls on Friday? 3.7% in terms of unemployment, the participation rate coming off again, and wages doubling. Where does that leave your view on the terminal rate?
I just think that the market's actually got a bit ahead of itself, to be honest with you. If you look at the move we've had over the last month, we've got a market that looks like the Fed is going to be more dovish than perhaps we expected. We look like we've got inflation under control, and we obviously had this jobs number that came out still strong. And I think that what we're looking at is a market that's looking for any sort of optimism, any sort of opportunity to, maybe it's this buy the bounce phenomenon that we're still seeing. I think we're still not through all the volatility yet that we're going to see. I think we're still going to see probably 50 basis points December again in February time. We've got to get the inflation under control in the US and everywhere else for that matter. So, I think we've perhaps just got a little bit ahead of ourselves, to be honest with you.
Hannah, dollar also erased more than half of this year's gains, and this is on repricing of what the Fed does. What does that mean for the rest of the world? Where do you see dollar?
I think the dollar is still overvalued. I think that what we will see as a result of that is, like I said, emerging markets, I think, will be more so the place to be than US. But then that said, I think subsectors of the US, we have seen very, very dramatic pullbacks. Like I said, areas of medical technology looking very good. Companies like Edwards Life Sciences, heart valve replacement, Thermo Fisher Life Sciences, very, very compelling entry points to those companies right now.
All right, Hannah, thank you so much. Hannah Gooch-Peters, our global equity investment analyst at Sanlam Investments. Now, coming up, China rolls back COVID rules in key cities across the nation as its pivot accelerates. The details are coming just ahead. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Tomorrow, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
This report is a little disconcerting.
Well, it still shows a solid labor market.
The labor market has not cracked.
We still have a significant inflation problem.
Inflation prospects are still worrisome.
And the markets have gotten a little bit ahead of themselves.
The market has really not listened to the Fed.
They're not going to stop hiking rates just yet.
Is the level of rates restrictive enough? That's really going to be the debate.
The Fed has to get to restrictive levels, and they have to stay there for longer.
I suspect that they will guide us to above 5.
Around 5-ish. 5 in front of them.
At least until the mid 5s.
They're going to be going to 5.5.
5% is going to be in the dot plot in December.
The Fed can't stop until the labor market starts to slow down.
Bloomberg TV gets weighing in on the latest jobs data out of the US and its implications, of course, for Fed policy. Strong US data on Friday is creating a bit of an overhang on market sentiment today in European and US equity futures. The China story is also, of course, part of the mix. Bloomberg's Kriti Gupta, we are very pleased to say, making a special appearance here in the London studio to walk us through some of these key market themes. We'll start with jobs.
Yeah.
Explain the market reaction then. The markets rally when CPI comes in softer, but you get a stronger than expected non-farm payrolls print, and the markets kind of go and shrug their shoulders.
Well, I think context is everything here. The idea that simply we were kind of going down this path of, okay, maybe the worst is behind us. This kind of stalling out you have in the Fed peak policy rate, that is really the story that's going to stick. Remember, you had that moderation in CPI. You also had a housing market that started to show some cracks in it. Your second-tier cities, think Seattle, for example, for our international audience, it is a second-tier city, and you're starting to see some of those housing prices come down. So the idea was perhaps some of the Fed's work is already kind of seeping into the markets, even though they operate at a lag. Until Friday. That's really where you really saw that turnaround. It's not just the headline payrolls number, it's the wage growth as well. And that's where you say, well, okay, the Fed still has a lot of work to do and the markets aren't pricing it in because at the end of the day, the policy rate, or at least expectations of it, hasn't changed. That's probably why you saw a shrug in the equity market.
So, Kriti, really the only theme that we care about is what does the Fed do with a hot jobs market, right? So they hiked rates to keep control of inflation, and suddenly they're like, what do I do with this? Because it kind of changes everything at the margin.
This is where the lag really comes in handy because the Federal Reserve's, any kind of hiking will happen an 8 to 12 month lag. And the hope for at least the housing market, for example, is that it's going to take that 8 to 12 months to finally show up. The labor market is a completely different story. And here's why it gets kind of perhaps nerve-wracking for the markets this morning is because wage growth, wage spirals in the past historically have only come down with crushing recessions. So it kind of feels like that's what's needed to take some of the steam out of the labor market, even though job openings are coming down, private payrolls are coming down, but it's still not enough for that kind of momentum.
And China is the other dynamic when it comes to the question of inflation, how to forecast into 2023 for markets, because China has made these concrete steps in the last few hours, the last few days, and it seems like that's going forward. China has, to some extent, been deflationary over the last year or so. China comes back, you weigh that up with the inflationary picture for the Fed next year, it becomes a complicated picture.
A very complicated picture, one that's not being priced into the equity market at all. And in fact, I'm waiting for someone to ask Chairman Powell, is the Federal Reserve actually actively addressing the China story? Because if you look at the narrative in the last couple of years, geopolitics, trade, tariffs, there's been this narrative that there's been this decoupling from China, when if you actually look at the numbers, that hasn't happened at all. And it's something that, for example, the equity market is completely discounting because the Federal Reserve is still the overhang, even earnings coming above China, even though China still is the story, and that's going to be a blind spot for a lot of investors.
Kriti, thank you so much. Kriti Gupta there on the markets. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Reports that Saudi Arabia's Crown Prince is preparing to invest in Credit Suisse Group's investment bank. The paper says Prince Mohammed bin Salman may invest about $500 million in the lender's CS First Boston spinout. Other investors could include former Barclays CEO Bob Diamond's Atlas Merchant Capital. Elon Musk says Apple has fully resumed advertising on Twitter, further de-escalating a brewing war between two of the world's most influential tech companies. Musk made the comments during a Twitter Spaces conversation over the weekend, adding that Apple is still the largest advertiser on the social media network. Archegos founder Bill Huang has asked a judge to dismiss fraud charges against him. He alleges that prosecutors engaged in what he calls deceitful conduct in the early days of the investigation. Huang says he was duped into assisting investigators who gave him false hope that he won't be charged. He's scheduled to go on trial next October over the collapse of the capital management company. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Thank you. Coming up, Wall Street Bank slash bonuses as the talent war appears to be coming to a close. We'll get the details next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Welcome back to the Open, everyone. 22 minutes into the European trading day, and this is what we're seeing across the board. Now, two main stories, of course, that we're watching. First, it's the U.S. jobs that we had Friday. Complicates the job for the Fed significantly. What does that mean for the dollar? What's the Fed to do with the hot jobs market? This is a question that investors will try and figure out over the next couple of days. After months of raising, of course, the interest rate benchmark in an attempt to curb inflation, the central bank's job has now gotten harder. Now, dollars falling, Asian stocks are rising. Tom was bringing us this, wonderful insight. This all has to do with the China reopening and the fact that traders are now betting that the economy will reopen quite significantly from COVID restrictions. That changes everything in terms of global growth. In Europe, the focus, I have to say, is a little bit mitigated because the DAX is still under pressure, 0.3% lower. The other thing we're watching is, of course, commodities advancing in general at the prospect of more demand of oil, for example, and other commodities from China. The other thing we're watching out for is OPEC Plus, pretty much unchanged over the weekend. That was a big story in terms of global assets that we were watching for a time.
Yeah, absolutely. That ties, of course, into the big energy producers, which is why we're looking at Eni, but BP and others, of course, within that space, given the flurry of news lines when it comes to oil and commodities over the weekend, whether it's China, whether it's OPEC Plus maintaining their output, or, of course, the Europeans agreeing on $60 a barrel as part of that Russian price cap. And by the way, seafaring and sea-bearing oil, that ban kicks in from today. Eni currently just off by 0.1%, so not moving significantly. Process, a very different story, of course, tied to China, specifically the gains that we're seeing in Tencent as investors start to bet on that stock. We were hearing from Hannah Gooch-Peters of Sanlam saying that she thinks Tencent is a good way to get exposure to a reopening China. Vodafone, you got change at the top here. The CEO, Nick Reed, it is being announced will step down to December the 31st. The stock up 2%. Under his reign, though, down about 45%. He's been in as the head, the CEO will have been by the end of that term for about 4.5 years, since October 2018. And the interim CEO is now Margarita de la Valle. But as you can see, investors are apparently rewarding that change at the top at Vodafone. So a couple of individual corporates we focused in on. We should also touch on what's happening in Credit Suisse as well. Of course, Francine sat down with the chairman last week. He talked about the fact that outflows had eased, in fact, positive in terms of some of their clients. And then the news over the weekend, again, according to reports, that Mohammed bin Salman, MBS, is looking potentially to invest in the investment banking part of Credit Suisse. Francine.
Now, as part of this week's MLive Pulse survey, we also asked our guests when in the Fed's hiking cycle default rates will jump. Here's what they said.
The peak is probably in. The Fed is guiding to a slower pace of hikes. So maybe they get almost to 5, but it's largely in the price. The market's not wrong to be sniffing out the possibility of a rate cut.
I think 5 to 5.25 is about what we are thinking as well.
The Fed's expectation for where this hiking cycle ends is higher than it was in September. We already had Powell telling us those dots will have moved higher, but how much higher is still, is still a question. And if those have been marked up, to a particularly high level above 5%, we heard Dudley mentioning that 5 to 5.5 range. If those have been marked up to something closer to the top end of that range, I think markets would move pretty significantly on that.
The Fed needs to back off. It is absolutely clear, and has become clear over time. A lot of that inflation is coming from disruptions on the supply side, disruptions from COVID, disruptions from the war in Ukraine.
There is a slowdown coming through, and I think the Fed is acknowledging that, and that's part of the reason why it's talking about moderating the pace of hikes relatively soon.
Some of our guests there on where in the Fed's hiking cycle default rates will jump. You can have your say in this week's MLive Pulse survey on the MLive blog on your terminal. The market's here currently down 0.2%, not picking up the baton from a very strong session over in Asia. Maybe the focus back on the direction of travel for the Fed. Steve with us. We're going to be speaking to the CEO of Galp after the break. This is Bloomberg.
is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Pressing the pivot to Asian stocks and commodity currencies rise as China accelerates the easing of COVID curbs across cities, including Shanghai. Crude maneuvers, Russia rejects the EU price cap, oil gains on optimism over China's reopening, and as OPEC Plus keeps production steady. And the Wall Street Journal reports that Saudi Arabia's Crown Prince, Mohammed bin Salman, is preparing to take a stake in Credit Suisse's investment bank. So, Tom, if you look at the markets, focus on jobs and focus on China.
Those are the two key themes, of course, key stories for these markets. That non-farm payroll coming in stronger than expected, unemployment 3.7%, and the participation rate as well, slowing again. So big question marks about what it means for the terminal rate of the Federal Reserve. And then the China story, as you're saying, Francine, over the weekend, some real concrete measures around restrictions being eased in cities like Shanghai, Guangzhou, Hangzhou, and Beijing as well. Currently, across the benchmark, you're seeing losses of 0.2%, so not picking up again what was a very strong session over in Asia. The MSCI Asia Pacific Index ended up more than 1%, very strong gains, particularly in Hong Kong, but that isn't being felt and isn't filtering through to the markets, the equity markets here in Europe. The DAX over in Germany off 0.4%, the FTSE 100 currently range bound. Across your sectors then, let's switch it over and have a look at the gainers. Just three stocks, or three sectors I should say, at the top of the list, and not by a great deal. Basic resources, okay, up about 0.9%. Iron ore is higher today, again on expectations that there'll be stronger demand out of China. Real estate also gaining up 0.7%. At the bottom of the list, you have food and beverage, media, chemicals as well, all off between 0.5% and 0.6%. So a bit of a modest session. Yes, downside broadly across the benchmark of 0.2%, but it seems investors still trying to get a sense of where the Fed will be positioning in terms of that terminal rate, given non-farm payrolls. Inflation data, of course, out later next week, which will be consequential. Let's get back to what's happening across the commodity story as well, because that was also significant in terms of the changes and developments in the last 24, 48 hours. Oil gaining this morning after OPEC Plus kept output steady. China making further progress towards that reopening then. And sanctions on Russian crude, well, they kick in today. Very pleased to say then, to walk through some of this, but also the transition to renewables, is Andy Brown, the CEO of Galp, which is Portugal's largest oil and gas company. Andy, thank you very much for joining us in the studio this morning. Tom. Happy Monday. Let's start with the news lines then. What is your take on the impact, the implications of this oil cap? Russia's trading at about $50. The price cap is $60. Does it make any difference? What's your take?
Not really, but they couldn't set it too low so that Russia would, react badly and take oil off the market. And they can't set it too high because you don't want to fund the war. So I think it was balanced right.
It was balanced right, but what happens concretely, and how much of a difference does it actually make going forward?
It doesn't make a lot of difference. Now, clearly, if the oil price goes up, we'll see how Russia responds to that. They had to set a cap, otherwise there would be sanctions on shipping services.
Right.
And so they had to set a number, otherwise there would be disruption in the market.
Does it affect the operations of a company like yours? Have you had to put contingencies in place? Have you been having conversations with officials in Brussels?
No, I think not at all. I think the product cap that will come in February may have a bigger impact than this oil price cap, but also a ban embargo in the European Union for importing Russian crude by shipping today. So that's a big change.
And overall, what kind of, energy policy does Europe need? I remember, it's been 10 years that we've said the US has a great energy policy,
Yeah.
Europe is fine, but we've been too dependent on Russia. When does this all change for companies? And what does it mean for Galp?
I mean, Europe has not focused on its indigenous supply of energy. It has not developed all of its resources, I think, effectively enough. Because there's been this demonizing of oil and gas, let's not have any more projects. And this is a transition, an energy transition, and I think the oil price was actually higher before the war, and the gas price in the last days of last year, higher than today. Why? Because supply was not keeping up with demand. So I do think the European Union has to look at its energy policy in a long-term transition basis rather than this kind of curtailment.
How much, we talked about the impact, of course, on that transition to renewables, and you at Galp have done your work along that, and we can question whether you've done enough. but in terms of that transition, you talked about this year as being a major step backwards. Does 2023 change, or are we in similar territory?
Well, it's a step backwards because there's more coal-fired power.
Yeah.
I mean, 20% more coal-fired power. I do think it can really mean there will be a rapid change to renewables over this decade, but the European Union has to do a lot more on putting the execution in place, putting the permits in place, really attracting investment rather than increasing taxes. So I do think there is a policy decision here, particularly to compete with America. With the Inflation Reduction Act, they're stimulating, they're putting more of the carrot than the stick. And I think that is something we need to consider.
And how are you looking actually at renewable projects? So first of all, how do you finance them? And are there outside investors that say, this is really the future for Europe, and so we're giving you billions?
Yeah, so we're spending half our capital on renewable and renewable fuel projects. And we're doing a lot of that in Iberia, where the costs, the levelized cost of energy there is really quite low. And with current electricity prices, this is an attractive business. As the market change, we'll look at more financing, more partnership models. But we're actually investing a lot today in that renewable platform. And it is an attractive place to invest today.
You heard us talking about the Federal Reserve terminal rates. To what extent does monetary policy, tighter monetary policy, act as a headwind to those plans?
Yeah. I think, as the renewable market used to be, where everything was sold forward and everything was financed, I think the interest rate is a major issue in that model. Today's model, a lot more is being put on the merchant market because prices are healthy. Now, when we revert back to the normal model where everyone's competing with the LCOE, there will need to be more financing. But this is going to be some years to come because gas is setting electricity prices. And as long as gas is so high, electricity prices will be very high. And so there's no imperative for companies like Galp to sell their electricity forward and finance.
Are you still selling your upstream operations in Angola?
We are looking at our whole portfolio. All our assets we will look at what the right time to divest whatever asset. So there's nothing to be said around that.
Okay, you touched on the CapEx spending, 50% of CapEx spending on renewables, or at least clean energy. Simplistic question, Andy. Why not do more? Why not be more ambitious, more aggressive?
Well, you said Galp's the largest oil and gas company in Portugal. We have a kind of responsibility to keep the country running as well. We have the only refinery in Portugal. We are the major distributor of fuels. We have to maintain the country moving forward. So we do need to spend some money still in our oil and gas business, to fulfill our responsibility to the country and to Spain and to Portugal. So there is a transition. I think if we all just stop investing in oil, and we've seen that. So the investment in oil is much lower now than it was, let's say, in 2014. And as a result, supply is not keeping up. So we have to play both sides of this as an oil and gas company, moving into an integrated energy company, invest in the oil supplies, but grow the other much, much faster, the renewables, the hydrogen, the lithium value chains, the biofuels, and that's what we're doing. We're really focusing on building that much more quickly, so at the end of the decade, we really are transitioning.
Andy, I know there was also force majeure in Nigeria. Can you tell us how it's impacting, actually, Galp going forward? I know there was something in shipments, for example, for October.
Nigeria's supplies have not been very reliable, and actually it's a very large, the 20 million tons of LNG come from Nigeria, and a lot of that, most of that comes to Europe. It's an important supplier, but they've had two issues: security issues in the Delta, which has, reduced the gas supplies, but then secondly, massive floods. Now, we've managed to overcome the first cargo that we missed, but, it is a big issue that Nigeria needs to stabilize because it's such an important energy supplier for LNG and oil to the world. So I think European Union needs to pay some attention to that.
And that also brings us to the topic around resilience, around Europe's energy sector. I know you've been thinking about this deeply. In terms of where we're positioned in the years ahead, we know that storage capacities are at, 98% now. Do we breathe a sigh of relief, or are we facing the same kind of issues, the same kind of threats of blackouts this time next year?
Well, I think it is going to be a crisis that will run a year or two. The problem next year is, as we go through the winter, depending on how cold it is, will that storage get to low levels, and will Europe be able to refill it or not during the year? The forwards in the market to the end of next year are still 140 euros per megawatt hour. So the market is believing that the gas will be tight all through next year and next winter. We'll have to see what 2024 brings. But this does mean that Europe has an issue on competitiveness. You've seen industries closing down, you've seen industries moving to the US with the Inflation Reduction Act. And so for Europe, I think there is a big challenge. How do we keep our industries competitive? I don't have all the answers for that, but it needs to be the key focus of the European Union, and not just on how do we get through this winter and how do we tax companies. It's how do we stimulate investment.
Okay, Andy Brown, really appreciate your insights. Thank you for coming into our London studio this Monday morning. The CEO of Galp on the need, of course, to build out better competitiveness across the European energy space, particularly with a focus on the Inflation Reduction Act, which we know, of course, is controversial within the halls of power in Brussels and across Europe. Coming up, it was a big weekend for oil with an OPEC Plus meeting and, of course, a price cap for Russian oil agreed by the EU. We've got the specific details on how we got to that point next. Stay with us. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 44 minutes into the European trading day this Monday. Losses across the European benchmark of 0.1% after a strong session in Asia. Investors weighing up, of course, the implications of easing, at least on the margins, China COVID restrictions, with, of course, the assessment that maybe you get a higher terminal rate on the back of that strong jobs data out of the US. Futures, talking of the US stateside, S&P E-minis down 0.4%. Now let's get the latest on what is happening in oil, another key story for us. A Kremlin spokesperson says Russia will not accept the $60 per barrel crude price cap agreed upon by the European Union on Friday.
The price is higher than where Russia already sells most of its crude. Now, the EU and G7 cap aims to hit Russia's revenues by stopping access to shipping and insurance for oil purchases or purchased above the price level. Now, today, the EU ban on seaborne oil imports also comes into effect. Now, for more on all of this, we're joined by Bloomberg's Europe correspondent, Maria Terem. Maria, so we have these sanctions on Russian crude imports taking effect today, as well as that agreement on an oil price cap. How big an impact could these have?
Well, Francine, that is a big question. And of course, you heard it from the Russians already say we do not accept it and we're not going to sell to anyone that participates in this G7 Russian oil cap. But the reality is today, as of December 5th, you are going to get a full ban on Russian imports of seaborne oil into the European Union. And the cap has been settled at $60 a barrel. Now, a lot of the time that I spent this weekend with my contact sources and so on was precisely asking that question. Is this going to work? Is it going to be effective? Where do we go from here? And the reality is, Francine, there was general consensus that it's about wait and see. This is a global industry. You have a lot of players. You assume that everyone here will have to play by the rules. The reality is that if you're an EU vessel and you get caught selling above the oil cap, of course, you're in trouble. You're going to be sanctioned. If you're an EU vessel that provides services to a third country that also goes beyond that cap, we're not going to be able to complete the transaction. But this assumes, of course, that every step of the way, everyone is going to play by the rules. So I think at this point, the consensus is let's wait and see for a few more weeks, particularly when it comes to the insuring.
Yeah, really interesting. We were just speaking to the CEO of Galp saying, not sure what the actual impact is going to be, have to watch and see, but also talking about the Inflation Reduction Act as well and the need for that in Europe. And I know you're also focused on those tensions between Brussels and Washington over trade. What is the latest there, Maria?
And Tom, that was a great conversation that you had, and it really encapsulates a lot of the anxiety that you feel in the European Union at this point, and they feel they have been hit by this perfect storm, a very aggressive industrial policy in the United States. Of course, the Inflation Reduction Act has become a major trade irritant between the EU and the European Union, and you have higher energy costs across the board for European companies. How do you stay competitive in this context? And yesterday we heard again from the head of the European Commission, Ursula von der Leyen, suggesting this is a trade irritant. It should not be at this point where there are so many geopolitical tensions going on already because of the war in Ukraine. She also suggested, by the way, and this is interesting, that the European Union could look into changing some of its state aid rules for its own companies as a response to the United States. And also, don't forget, this week, the Trade and Technology Council between the EU and the United States meets. That statement, of course, will be closely watched and monitor whether or not the situation escalates or, in fact, it de-escalates.
Okay, an important story, an important tension and dynamic, as you say, between the US and Europe when it comes to the question of trade and the controversies around the IRA. Bloomberg's Maria today on the ground, of course, in Brussels for us. Thank you. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Chinese authorities have eased COVID testing requirements in several major cities over the weekend. Shanghai, which saw a grueling 2-month lockdown earlier in the year, has scrapped PCR testing requirements to enter outdoor public venues such as parks or to use public transportation. Hangzhou, home to tech giant Alibaba, has also dropped testing requirements to enter offices and supermarkets. Sam Bankman-Fried says he will testify before the US Congress. The chair of the House Financial Services Committee invited the founder of collapsed crypto exchange FTX to join the panel's hearing scheduled for next week. Bankman-Fried says he'll appear after he's finished, quote, learning and reviewing the events that led to the implosion. He says he's not sure that will be in time for the hearing. South African President Cyril Ramaphosa's lawyers will challenge an advisory panel's report that said there may be grounds for his impeachment. The panel said last week the president may have committed serious misconduct and constitutional violations. This is as the governing ANC's top leaders hold a crucial meeting on how to respond to the report's damning findings, which Ramaphosa denies. The UK's RMT union has rejected an offer aimed at ending railway strike action planned before Christmas. The union says the pay rise of 4% this year and another 4% in 2023, along with reforms to working practices, is not acceptable. Rail workers who planned strikes on 8 days in December and January join a growing wave of workers taking industrial action in the UK over pay. A top Iranian official says the operations of the country's so-called morality police have effectively been suspended. The unit has for years patrolled Iranian cities, arresting those it deemed were flouting the Islamic Republic's strict religious dress code. The move comes after months of widespread anti-government protests over the death of a young woman in its custody. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice, thanks so much. Alice Atkins in London. Coming up, reports that MBS is planning to invest about $500 million in CS. We'll bring you the latest on the developments at the Swiss lender. That's coming up next, and this is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open, everyone. We are 53 minutes into the European trading day. The focus firmly on China, the focus also firmly on those jobs report out of the U.S. Actually, it makes the Fed's job so much harder to try and figure out what they do next. We also had some France November services PMI. They came in pretty much as expected. So services PMI 49.3 instead of 49.4. So maybe a little bit lower than expected. The composite is pretty much exactly bang on as expected. And then Italian services PMI, again, anything below 50 means it's in a contraction, so it's not a great number, but at least it's in line with expectations. It even beat expectations a touch. I'm not seeing any euro-dollar movement. The FTSE 100, probably an energy and oil story, turned a little bit positive, gaining some 1%.
Yeah, hasn't moved the euro, currently trading
1/10 of 8%.
1/10 of 8%. Euro currently trading at 105. In the session, just up 0.2%, but not a lot of movement on the back of that PMI data. Let's get back to what's happening across Wall Street, though, because the Wall Street, or at least when it comes to Credit Suisse, the Wall Street Journal is reporting that Saudi Arabia's Crown Prince Mohammed bin Salman is preparing to invest in Credit Suisse Group's investment bank unit, and the shares are rallying on the back of that story. Joining us now is Bloomberg's Tom Metcalf. Tom, what is this deal likely to look like? What are the details? How important?
Yeah, it's a really interesting story. It appears that MBS is going to be investing in this almost in a personal capacity. Obviously, we saw, the Saudi National Bank has taken a 10% stake in Credit Suisse. But it seems to be 500 million coming from, MBS as a estate or something along those lines in that investment bank spin-off. So he'll be one of the anchor investors if he goes through with this. And it looks like maybe he'll be joined by Bob Diamond, another old character from Wall Street. So there seems to generate quite a lot of interest for this particular unit.
So, Tom, how much do we know about whether this is a personal connection with Michael Klein? Right, Michael Klein, the rainmaker at Citigroup. I know for many years he was actually advising MBS, and certainly he was the one that started the FII conference in Riyadh. So is this a personal connection, or is it that they see value into the investment bank?
I think certainly Klein is working his Rolodex, right? And it makes sense, right? You go to where the money is, and there's no more money in the world than probably in Saudi Arabia right now. So I think that's where his sort of short list of investors have come from. And then, you presume they've taken a look and hey, they think Credit Suisse, historically a strong franchise, really in the sort of down in the dumps at the moment. But if Klein does what he says, you'd think this will be a very good investment.
Okay, so from Credit Suisse to broader Wall Street and the banking sector here in the UK as well. The donut, the bagel, the goose, bonuses not looking good. Explain.
Yeah, exactly. So there's one of the details in the story about how the bonus season is sort of shaping up. And for some people, at least, it's going to be pretty grim. There's talk of this bagel, basically 0 bonuses, which is a pretty strong message if you're on the receiving end of that. And for me, what was the most interesting thing is I think we've been hearing about the investment banking sort of operations going to be really hit on the bonus front. But what we heard last week was actually some trading operations. Even at Goldman Sachs, they are going to have sort of declines in their bonus pool. And that just kind of goes to speak, I guess, to the sentiment out there. And, it probably will be a fairly downbeat bonus season.
And of course, we're all wondering what that means for the battle for talent. But that will have to be answered in the next hour because that's all we have time for. Tom Metcalf there from our banking team.
European equities currently range-bound, the euro-dollar at 105. German November services PMI coming in a little softer than the estimates, 46.1. Plenty more coming up across these markets and analysis. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Pressing the pivot, Asian stocks and commodity currencies rise as China accelerates the easing of COVID curbs across cities, including Shanghai. Crude maneuvers while Russia rejects the EU price cap, oil gains and optimism over China's reopening, and as OPEC Plus keeps production steady. And the Wall Street Journal reports that Saudi Arabia's Crown Prince Mohammed bin Salman is preparing to take a stake in Credit Suisse's investment bank. So good morning, everyone. Let's first of all check on the markets. I have to say, if you're the Fed and if you're a Fed official right now, you would have looked at that U.S. jobs report on Friday and said that really complicates my life. After fighting inflation for a long time, that strong U.S. jobs number just makes it a lot more difficult on how they move forward. Now, two stories that European stocks are looking at, actually three. Let's put in oil and OPEC Plus. Over the weekend, not doing much, or certainly looking at the situation instead of putting more barrels or taking off more barrels. Then there's a story in China getting rid of COVID restrictions. Could that mean that we're going to see a huge demand in energy and commodities for China? And then the third story, of course, is U.S. jobs. So for the moment, European stocks pretty much unchanged. The dollar index, 1,255. We chose a Bloomberg U.S. dollar. We could have chosen euro dollar. Maybe we'll do it shortly. And then Bitcoin. Look, the trials and travails of Bitcoin is something that we focus on, currently at 17,358. Now, we did have quite a lot of PMI figures. All of them. Again, just a reminder, I know everybody knows, but anything below 50 means that there's a contraction. So if you look at the contraction, we saw it in France, we saw it in Germany, we saw it in Italy. Italy, though, coming in a little bit better than expected. Euro area, November services PMI coming in at 48.5 instead of the preliminary 48.6. So let's also have a look at whether it impacts the European map. But Germany, November services PMI coming in a little bit lower than expected. Again, it's just at the margins. And all of these PMIs are below 50. You can see the difference, for example, between a DAX down 0.2% and a FTSE that's gaining 0.1%. Reminder, this is a lot of energy resource companies actually listed in the FTSE 100. If you look at the FTSE 250, it's probably a very different story. Now, China's offshore yuan strengthened through the closely watched 7 per dollar level for the first time in nearly 3 months as authorities accelerated a shift towards reopening the economy. We're also joined now by Bloomberg's Chief China Markets Correspondent, Sofia Horta Acosta. Sofia, thank you for joining us. When you look at this shift over the weekend, is it going to be a stop and start on COVID restrictions, or do you think that this is a real game changer for the economy and for stocks?
It really is, Francine, the direction of travel that markets are betting on. And markets tend to price everything in advance. So there is obviously a lot of caution on the ground. When we talk to people on the ground, there's still a lot of restrictions on movement. But the key thing here and the key news over the weekend was, first of all, there was no unrest, no protests. And also that Shanghai, this is China's biggest, most populous city, but also, importantly, the city where that went through 2 months of really, really harsh lockdown earlier this year. The restrictions there are being pulled back. You no longer need a PCR test to go into a park or to use public transport. The expectation is that we'll get people consuming, moving around the city, and that's really boosting confidence in the market today. Francine, the Hang Seng Tech Index was up more than 9% today, and obviously
Let's also bring in our Kriti Gupta, our on-air markets correspondent. Kriti, when you look at global markets, and I want to ask Sophia specifically about some of the sectors and maybe some of the regulation that could surround, for example, gaming and others. But how is the China news going to impact the U.S.?
Well, it's hard almost to price it in because, once again, the timing is really a moving target. And what's struggling here is this even on the radar of the Federal Reserve? Because at the end of the day, that is what's driving markets globally. And right now, it kind of feels like it's a little bit of a blind spot. How do you price in something that is expected to happen potentially in March, potentially in June of 2023, at the same time as the peak policy rates from the Federal Reserve also overlap at the exact same time? So it really is a blind spot right now. And I think a great example of that is what you're seeing in the futures market today. Asian markets are rallying, they're ripping, they're roaring. You look at the futures in Europe, look at the futures in the United States, and that's really where you're starting to see pain, which tells you the Federal Reserve is the bigger overhang.
So, Sophia, do you see it as a little bit of a blind spot for the Fed, or is it just that it's very difficult to understand the China policymakers' thinking? Again, in the past, we thought they were reopening, and then they've gone backwards and forwards because of demographics. And how does regulation also play in?
I think you made a really good point there. How do you track the thinking, and also how do you track what's actually going on in the ground? And I think the big misunderstanding here is that there will be a reopening at a certain date and time. This is not how China does things. It's not going to be like in the UK where you had that big reopening party, COVID is over, Victory Day. That's not what's going to happen. So you have to almost track the daily changes in narratives and really the minutiae of what's going on in Chinese cities, and that's really demanding for if you're in London or in New York. But the one question that everyone is asking me now is, what does this mean for inflation? If China does reopen, if we get a pickup in demand, and China is a big consumer of oil, a big importer of oil, what does this mean for the inflation story? Is it good for inflation? Is it bad for inflation? Where's that going to go? So I think that is the big blind spot, and there's still a lot of debate around what will happen if we do get that pickup in demand. The consumer story, I mean, in China, the consumer was already weak before COVID-0 really hampered or restricted movement. So it's also unclear how much of a pickup in demand we'll get. But really, I think the point there is that the China story will be played, that macro story will be played more in Asia than probably in markets where you are and in the US.
Sophia, just very quickly, I know like in the last couple of years, we had, again, quite a lot of crackdown on excessive spending, on gaming, on celebrities, on kind of excess, also luxury spending and things that were not deemed to be, I guess, culturally of higher purpose. Is that changing in any way? And what does it mean for specific sectors?
Yes, conspicuous consumption is definitely not in fashion in China and hasn't been, especially for the past 2 years. I mean, common prosperity hasn't gone away. That's still the major theme under Xi Jinping, and it will likely be so in his third term. Stocks like Maltai, that's the big liquor maker where in big Chinese festivals, you give one bottle and they cost more than upwards of 1,000 yuan per bottle. That kind of regulation, cracking down on conspicuous consumption will still be a major theme. But really the premiumization, and that's a really difficult word to say, but it is a tag word that people like to use when they play the China story. The middle class, the Chinese middle class, that's still gaining in wealth, and that's the trajectory for the next 10 to 12 years, 1 to 2 decades. So that's still a big story coming into play. It's difficult to see where that's going to go next year, though.
Yeah, it certainly is. It's also difficult to know what happens to the U.S. jobs market. So you're the Fed right now, and you look at the hot jobs market. What do you do with it?
That's the question of the day. And I think, back to Sophia's original point on the commodity picture, that has to get factored in as well. And it almost feels like if you're trying to tackle a labor market that just won't quit, essentially, you also have to factor in a commodity inflation, or price in the fact that eventually commodity inflation will actually come down in line with the rest of the economy. The problem is that's diverging right now, and we have no historical parallel to say, when has commodity inflation come down and the jobs market still stayed strong? That has never happened before, because traditionally they come in all together, and that's where the Fed has to write a brand new rule book about how to navigate this.
Yeah, and of course, the monetary policy transmission also takes time. So are they data dependent, or are they also, there's always a lag in what they did last quarter?
Well, they like to say they were data dependent, right? That's the buzzword of the last 2 years, essentially. But I think the lag is really where they are hitting a much more tougher spot. Because if you're looking at a lag of 8 to 12 months, how do you make a decision right now about whether it's actually effective or if you need more? And this PTSD, essentially, of the Volcker era of pulling back too early, that is still kind of hanging in the air. And I think that's where you're seeing divergence within the committee itself.
Yeah, and then you're seeing, of course, a change in dollar. I mean, on the data dependence, I think now what they look in the forecast is actually what they did last time. So again, it's kind of a lot more difficult to forecast what data does because of the hikes that they've implemented over the last 7 months.
Right, and the story hasn't really changed, has it? I mean, if you look at the last couple of months, we are still at very high inflation. We're still not seeing signs of that momentum that the Federal Reserve really needs for a proper pivot, or even to utter the word of a Fed policy cut, for example, something that the markets are already pricing in. I think the game changer for the dollar, though, is that you're already seeing this kind of idea priced in by currency strategists that this is done. The peak policy rate is in. We're already pricing it in, and the big run that the greenback has had, that's priced all of it in into 2023. What happens when that turns around and you now look at a peak policy rate that potentially goes above 5.5%?
Sophia, what do you do with yuan right now?
Sorry, I missed you there, Francine.
On renminbi, what do you do with renminbi right now?
It is still relatively a dollar story. It'll be interesting to see how the PBOC reacts to this. It has allowed for more strength, and the key thing for the PBOC is not actually the kind of round number anymore, it's the pace of gains. The PBOC, though, is a lot more interested in how the yuan is faring compared to the trade-weighted basket. That's the basket of 24 trading partner currencies, and that's the euro, the pound, the yen. Those currencies are really the biggest driving force. We do get trade data this week on Wednesday. Let's see how China's import and export growth is. That could really change the outlook for the currency. But right now, currency forecasters are looking at 7 per dollar handle. That's likely to stay until at least the end of the year, if not through March, when we get that economic growth target for the next year.
All right, thank you both for joining us. Our Bloomberg Chief China Markets Correspondent, Sofia Orta-Costa, and our on-air Markets Correspondent, Kriti Gupta. Now, coming up, we'll get more on what's driving markets with LBBW Chief Economist and Head of Research, Moritz Kramer. I don't think he has a favorable view on investing in China right now, so we'll get to the bottom of why that is. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Tomorrow, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're joined by Moritz Kramer, Chief Economist and Head of Research at LBBW, to talk about the markets, China, and that U.S. jobs report. Moritz, thank you for joining us. When you look at the U.S. jobs, how much of a nightmare is it actually for the Fed to deal with these hot jobs report?
Well, good morning, Francine. I think for the Fed, that made things a little bit clearer because there was a wobble in the thinking. And certainly the markets had made up their minds that we're close to peak time because peak inflation pretty much seems to be behind us in the US. But the labor market data was a stark reminder that we're not anywhere near yet. So the Fed is going to do what they said they would do. I think I expect sort of another 50 basis points, but they're close to the end because they started pretty early. So we're now at 4, probably there are 2 or 3 more hikes to reach like 5%. And then we're there. And then, you get this crossover point sometime during next year where the inflation rate dips below the Fed rate. And I think this is when we can start talking about rates going down, but not earlier.
Moritz, what happens to the dollar from now? So the U.S. dollar erasing actually half of this year gains as there's expectations growing that the Fed will temper rate hikes, and at the same time we're seeing a slow reopening of China.
Well, premature, if you ask me. I think this weakening of the dollar that we have seen is not based on fundamentals. So we at LBBW, we expect sort of that the parity line will be crossed again next year. And not by very much, but we see sort of the euro dollar at 97 cents sort of in the second quarter probably. And the reason is that in terms of the business cycle as well, we are sort of much harder hit in Europe, where I predict a real recession, not just like hovering around the 0 mark, whereas the US is probably able to escape that fate, not by a wide margin, but still. And therefore, also what you see in the expectations of the interest rate declines in the US on the short end. That feeds into this weakening dollar, but by extension, if I think that the interest rate projection of the market is overly optimistic, then the same applies to the dollar rate.
But overly optimistic also about China's reopening prospects?
Yeah, now that's the big headline news, of course, over the weekend, and we're sort of devouring all the news coming out of there, trying to make sense. But look, Francine, at the bottom, nothing has really changed. The vaccination rate is what it is. Yes, they want to make an effort to vaccine the 80-plus cohorts, but that's going to take months. So, the Chinese leadership is now taking a big gamble by opening up because the infection rate they will go up, and there will be deaths. There will be many, many fatalities in the millions, probably, if you let this run, maybe in the dozens of millions. So he's sort of between a rock and a hard place now, Xi Jinping, of course, I refer to, because you cannot go on as you have right now, because this will just sort of not only harm the economy. I think he would be willing to live with that, but the risk to social stability is clearly visible on the streets. But if you open up too much, you might get the virus running out of control, and then you have to clamp down and lock down again, and that would be huge reputational damage. So the escape route for the Chinese leadership is extremely narrow here. So and I'm doubtful they'll find that sweet spot, if it even exists.
Moritz, what happens to Europe, actually, in the next 6 to 18 months? I don't know whether we're overly optimistic about having peak inflation and being able to deal with the energy crisis.
I would think there is a lot of willingness in the market over here, this side of the Atlantic as well, to see things in a sort of with rose-tinted glasses. I know it's Christmas season as well. You know, everyone has a long wish list. But remember, as a child, you wrote this long wish list and not everything came true. And the same will be true for the markets. So no, we're probably not above the hump yet. We're pretty close. I would still think that into early 2023, we'll have two-digit inflation. But more importantly, inflation will come down, of course. But more importantly, we will have a recession. So for the Eurozone, we are predicting at LBBW a contraction of 0.8% over average next year, and for Germany about twice the size. And the reason is that we're much harder hit by this energy crisis, which is not going to go away anytime soon. So we're trying to mitigate. But for industry, and Europe is a very industrialized place, and Germany more than any, this is a big hit to competitiveness. And of course, consumer confidence is at an all-time low. So I would be really surprised if the positive and optimistic market expectations about the macro environment would really come true.
All right, Moritz, thanks so much. Moritz Kramer, their chief economist and head of research at LBBW. Very grateful you're joining us this morning. Now, coming up, Wall Street banks slash bonuses as the talent war appears to be coming to a close. Well, more on that later in the program. And this is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Chinese authorities have eased COVID testing requirements in several major cities over the weekend. Shanghai, which saw a grueling 2-month lockdown early in the year, has scrapped PCR testing requirements to enter outdoor public venues such as parks or to use public transportation. Hangzhou, home to tech giant Alibaba, has also dropped testing requirements to enter offices and also supermarkets. Now, South African President Cyril Ramaphosa's lawyers will challenge an advisory panel's report that said there may be grounds for his impeachment. The panel said last week the president may have committed serious misconduct and constitutional violations. This as the governing ANC's top leader hold a crucial meeting on how to respond to the report's damning findings, which Ramaphosa does deny. The UK's RMT union has rejected an offer aimed at ending rail strike action planned before Christmas. The union says a pay rise of 4% this year and another 4% in 2023, along with reforms to working practices, is just not acceptable. Rail workers who plan strikes on 8 days in December and January join a growing wave of workers taking industrial action in the UK over pay. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We continue looking at onshore yuan extending gains about 1.5%. That's the most in 3 weeks. Now, this is, of course, as their optimism continuing, and that's boosting the currency. The yuan surged past the key level of 7 per dollar earlier in the session for the first time since September. Coming up, we talk China, we talk oil, we talk OPEC. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pressing the pivot to Asian stocks and commodity currencies rise as China accelerates the easing of COVID curbs across cities, including Shanghai. Crude maneuvers, Russia rejects the EU price cap, oil gains and optimism over China's reopening, and as OPEC Plus keeps production steady. And the Wall Street Journal reports that Saudi Arabia's Crown Prince Mohammed bin Salman is preparing to take a stake in Credit Suisse's investment bank. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get the latest on oil now. A Kremlin spokesperson says Russia will not accept the $60 per barrel crude price cap agreed upon the European Union on Friday. Now, the price is higher than where Russia already sells most of its crude. The EU and G7 cap actually aims to hit Russia's revenue by stopping access to shipping and insurance for oil purchased above the price level. Well, today, the EU's ban on seaborne oil imports actually also come into effect. Now, for more on all of this, we're joined by Bloomberg's Europe correspondent, Maria Tadeo. Maria, good morning. So we have these sanctions on Russian crude exports taking effect today, as well as the agreement on the oil price back. So how big of an impact could these actually have?
Yeah, and it's a big day, Francine, because remember, there had been talks and weeks and a big diplomatic spat back and forth over the price of this oil cap, and it has now settled and gone effective at $60 a barrel. Today, you also have this full ban on Russian seaborne oil coming from Russia, of course, into the European Union. European officials and the institutions today saying this will do or will inflict severe damage on the Russian economy as the war in Ukraine continues, and immediately that response from the Kremlin suggesting they are not going to accept this and will not sell to any country that participates in this G7 oil cap. Now, the question going forward, of course, is will it work? Is this going to be successful? Will it be a flop? Can you get around it? And Francine, that's a question that I put to a lot of contacts over the weekend, and the general response that I got is, wait and see. This is a big global industry. Of course, there's a lot of players that are involved here. You assume that everyone would play by the rules, but sometimes we know in real life that doesn't happen. So the overall response is, let's wait and see and keep a very close eye, in particular, on the insurers.
So meanwhile, tensions between the U.S. and the EU continue over trade. What's the latest?
Francine, this is the biggest story. Of course, we have to put Ukraine aside. Ukraine is a dominating story on everything across the geopolitics in the world, of course. But when you look at the Brussels institutions, the Inflation Reduction Act, this is right now top of the agenda for most officials. They do believe this could become potentially a big trade irritant. They fear potentially a trade war between the United States and the European Union. Yesterday, we heard from the head of the Commission, Ursula von der Leyen, once again warning that it has created distortions in the market, that there needs to be a level playing field. And she also suggested, and this is where it gets very interesting, that the European Union could also change some of the state aid for its companies as a response to the Inflation Reduction Act. This is also an important week because the Trade and Tech Council will meet. Of course, that brings the United States and the European Union together, and that statement is now closely monitored to get a sense as to whether this escalates or actually will they find common ground and avoid anything that looks like a trade spat between the two.
Maria, thank you so much. Maria today there with the very latest out of Brussels. Now, the Wall Street Journal is reporting Saudi Arabia's Crown Prince, Mohammed bin Salman, is preparing to invest in Credit Suisse's investment banking unit. For more on all of this, we're joined by our Swiss banking reporter, Marion Halftermeyer. Marion, thank you so much, as always, for joining us. This feels like a very significant deal. And also, Michael Klein had personal ties, actually, to the Saudis, also when he worked at Citigroup as a rainmaker. So how much do we know this is a, I guess, sign of confidence in Michael Klein? How much of it is in Credit Suisse?
So, Francine, the bank has guided that they've been talking with different potential interested parties for the Credit Suisse First Boston spin-out. So this is the first name we've sort of seen come out. But let's put this into context. The Saudis have also expressed interest in being a key anchor shareholder. They're participating in that $4 billion capital raise through the Saudi National Bank. So there's a lot of interest around the Saudis, and the Qataris have also long been invested in Credit Suisse. So it is a sign of we're going to stand by Credit Suisse. We're interested in different parts of Credit Suisse.
So how big of a deal, Marion, what are we talking about? Like, how much money is it, and does it make a difference to international shareholders? Is it, if it's a Saudi investment, firm, or whether it's the Crown Prince himself?
So I think from a figure perspective, we're looking at $500 million. Now, the bank had already guided that they had an interested party for $500 million as well for just the Credit Suisse First Boston part. So it's unclear whether that's the same $500 million or not. I think from an international perspective, it doesn't necessarily cause a deterrent. I mean, everyone has long known that Credit Suisse has had Middle Eastern backers. So it's just a matter of how that investment is put into play, whether they get a board seat, and then all that is very unclear because we don't really know yet how Credit Suisse First Boston is going to look like once it's carved out of the larger bank.
Marion, when do you see the share price? So there was a huge reaction on Friday. There was another reaction today for Swiss banking. Is it too soon to say that investors are getting behind this because of the capital raising?
It's unclear. I mean, they've certainly been able to break the losing streak that they've had. It was really historic and getting a little scary. I think a lot of people were getting a little nervous. But now it's a telling sign that maybe they've put their money where the mouth was, where they've raised the capital, they've had a debt issuance. And so things are looking a little more stable. The chairman guided that liquidity was getting back to normal or closer to normal, so that's also helpful. And, they're obviously looking at trying to get some of the asset outflows that they've had come back to the bank. So there are some positive signs emerging. It'll be, we'll have to see how the year caps out and what will happen next year.
Marion, talk to us a little bit about some of the other anchor investors. So there's also a Saudi bank. We know that David Harrow of Harris Associates has a big chunk. I mean, do you expect a lot of the shareholding to move with the share price dilution?
It's interesting. I think we will probably see some of the main shareholders, including David Harrow's and Harris Investments and the existing Qataris who have about a 5% stake, probably keep their stakeholding. I think we're going to see them participate again. I think the bank has guided that their existing shareholders are supportive, and so we'll see them show up, I think, in the cap stack once we get that. As for the rest of the investor makeup, it's historically been very Swiss held as well, so anticipate that to continue because you have a lot of caps on investment and pension funds having to invest in Swiss stocks as well.
Great. Thank you, as always, for some great reporting. Of course, our lead reporter on some of the Swiss banks, including Credit Suisse, Marion Halftermeyer. Now, coming up, could Europe become one of the world's largest legal cannabis markets? We'll get more on that, on the drug's medical uses in the continent. That's coming up next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the use of medical cannabis is on the rise. Independent investment bank Brian Garnier sees Europe's illegal cannabis market growing by 62 billion euros by 2032. That's up from only 700 million euros this year. We're now joined by Nicolas Weiss, the senior research analyst for beverages, cannabis, and agri-tech at Brian Garnier. Thank you so much for joining us. I mean, first of all, I was in New York just a couple of weeks ago, and it's amazing. You just smell weed everywhere. You walk, and at first, you need to get used to it a little bit. Where do you see, in terms of regions and countries, the biggest growth for this market?
Well, it always starts with medicinal cannabis, and that is what we've seen also what we're also seeing in Europe. We've seen Germany introducing medicinal cannabis in 2018. UK also 2018.
So this is CBD, right?
No, medicinal cannabis. That's separate from CBD. Yeah, CBD market is different from the cannabis, medicinal cannabis, or the recreational cannabis market that we have.
Yeah. So if you look at CBD and if you look at medicinal cannabis, are the two linked? If there's one, is there going to be an increase of the other one because regulation in general will open up, or are they completely different markets?
They are different markets. CBD is much more wellness-based, whereas medicinal cannabis is more for certain therapeutic benefits that you want to achieve.
So which one's bigger? Which one can grow bigger?
Oh, the medicinal cannabis market, without any doubt. For Europe, we are expecting that this market can go to 10-12 billion euros by in 5 years' time. Yeah.
And this would be what, thanks to regulation? So it has to be doctors that prescribe it,
absolutely.
right?
It's currently the regulations are very limited and very restrictive, and that is also because the health authorities, they need to have proof that something is working. They need to have hard evidence on therapeutic benefits, trials. Otherwise, they will not allow this product to be promoted to their patients. But all these countries are currently in the process of setting up trials or doing trials, including UK. In the UK, we have now 15,000 patients who are in clinical studies, and where regular feedback is given to the NHS on how these trials are going.
So, Nicola, talk to us a little bit about who makes this medicinal cannabis. So is it companies outside of Europe? Like, who would benefit when this really expands and increases fivefold?
Well, there are different type of companies who are producing this products or selling these products. Obviously, the North American companies, where you already have a medicinal and adult use market, are also producing medicinal cannabis and exporting it to Europe. Next to that, you have venture capital-based European companies who are being set up to produce and to sell medicinal cannabis. And next to that, you have also a couple of companies which are already on the stock market quoted.
So does it replicate basically the growth that we've seen in the US?
with a certain delay.
2 years delay?
Well, maybe even 5, 6 years delay. I believe in the recreational market of cannabis in Canada was agreed in 2018. You have in the US, you started gradually seeing the states introducing medicinal cannabis, starting with California in 1999, recreational from 2013 onwards. So we are now starting in Europe, so it's like nearly 10 years later. But that legalization is spreading across the globe. And
So Nicholas, talk to me a little bit about CBD. This is for wellness, so it's not necessarily recreational, right? How do you define it? And I was interested in your research in reading that actually the UK has the biggest potential for CBD user, which values at around 150 million pounds.
Yeah. There are 3 big product categories in CBD. First is the oils, the tinctures, and they are being sold here in the UK. You have novel foods, CBD in food, which is currently held back by the European regulators, and because they need to have safety tests showing that it is safe for people to consume, obviously. And then next to that you have the flower itself, the smoking of the CBD flower, which is a very large market in those markets that allow this type of product. That's, for example, France, Switzerland, Austria, Belgium, who allow the CBD.
So when you look at, Nicholas, and I was really interested, the top 5 European markets, Germany, France, Italy, Spain, and the UK. Again, if you look at timelines, so is the UK just more advanced in terms of liberalizing, in terms of usage, than the rest of Europe, or do you think it's just going to be a vastly different market?
No. The countries that are most advanced in Europe is Israel, it's Switzerland, it's Germany, Malta, Luxembourg, Portugal. UK is a little bit behind, and especially currently, it's everybody's probably looking at what Germany is doing. Germany has asked the European Commission if it can put a recreational market in place in Germany, and it has its own legal implications that it is trying to solve. And I suppose that is where everybody will be looking at how Germany will be solving these problems. And UK, France, Spain are expected to come in more in like a second wave, say in 3-4 years' time, before they start allowing recreational cannabis.
Nicholas, thank you so much for joining us. Nicholas Fesch there, a senior research analyst for beverages, cannabis, and agri-tech at Bryan Garnier. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried says he will testify before the U.S. Congress. The chair of the House Financial Services Committee invited the founder of collapsed crypto exchange FTX to join the panel's hearing, which is scheduled for next week. Bankman-Fried says he will appear after he has finished, quote, learning and reviewing the events that led to the implosion. He says he is not sure that will be in time for the hearing. Now, Elon Musk says Apple has fully resumed advertising on Twitter, further de-escalating a brewing war between 2 of the world's most influential tech companies. Musk made the comments during a Twitter Spaces conversation over the weekend, adding that Apple is still the largest advertiser on the social media network. And Archegos founder Bill Wang has asked a judge to dismiss fraud charges against him. He alleges that prosecutors engaged in what he calls deceitful conduct in the early days of the investigation. Wang says he was duped into assisting investigators who gave him a false hope that he won't be charged. He's scheduled to go on trial next October over the collapse of the capital management company. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, Wall Street banks slash bonuses as the talent war appears to be coming to a close. More on that next. And this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, just less than a week ago, Wall Street's biggest banks were locked in a vicious bidding war for top talent. Now, not so much. Now, a slump in deal-making and 2022's market swoon are threatening bonuses and even pay. That's our big story. Today, we've been following it very closely. It seems that over the last 2 to 3 months, many banker bonuses were really about, trying to retain or even trying to attract top talent. There is one man that covers it all, including the City of London. And of course, maybe we talk about the banker bonus cap here in the UK. With that's been taken off. Joining us now is actually Bloomberg's Tom Metcalf. Tom, thank you for joining us. I mean, we're all obsessed by bonuses. I mean, we're not, but of course the people that get the bonuses are. So why are we hearing about, some of the big banks that presumably are making a lot of money in this period of volatility slashing bonuses?
Yeah, it is the season for banker bonuses, so it's all people in the City of London are really thinking about right now. And yeah, the messaging is pretty downbeat, and for some that will be surprising, because when we've looked at these quarterly results over the year, you've seen, Barclays traders do great, Goldman traders do great, just because of the market volatility. But then last week we heard, hey, guess what? Even if you're a trader, you might be in for a bit of a nasty shock. Like Goldman, probably leader of the pack really on fixed income, etc., is saying, look, you're going to expect sort of low double-digit declines, which is a big surprise, because normally, it's eat what you kill, right? It's if you perform, you'll do well. So to your question of why, I think it's twofold. One is, particularly the banks are still getting pressure on costs, obviously from shareholders and stuff like that, and this is, one of the big line items, so it's very difficult to get away from, not messing with this. And then secondly, it's more of a look forward, right? So yes, 2022, great year for trading, but it seems that a lot of the banks are now looking ahead to 2023, seeing tough times, and that all feeds into their calculation. And, it's, a calculation indeed on like sort of a war for talent, right? So if they think, we can pay a bit less and still keep people because there's fewer jobs out there, there's a bit less competition, then it's that kind of game of just trying to find the least they can pay and get away with, basically.
I mean, as our trader whisperer, Tom Metcalf, do traders kind of get mad because their bonuses are slashed and try and look for another job straight away? Or is it, again, how complicated is it finding a new job in this kind of environment? Like, should they worry about losing talent?
Yeah, look, I think the top performers, rightly, when they see probably stories like this, they get a bit antsy and wonder, hey, will I be rewarded fairly? Yeah. I think typically, there is a bell curve here, right? And I think if you've blown off the doors at your bank, then you'll probably still be okay, because they'll be desperate to keep you. It's probably more the middle ranking traders, or, obviously the underperformers are really going to get hit. So I think, in terms of the process, whether they leave immediately or not, I mean, if I were them, I'd wait till I get my bonus, which is why they sort of delay it, exactly, February and March, and I think the banks would be hoping by that point, the sort of, maybe the messaging is a bit clearer, they've been able to keep people.
So who have we heard from? From Goldman's, I think JP Morgan. What does it mean for the poor European banks that even in the past couldn't really quite match up those salaries and bonuses.
Yeah, exactly. So Goldman came out and talked a bit about the traders. We also had Jefferies coming out and saying, hey, this is going to be a difficult bonus season. And so, that all feeds into the European banks' calculations. What we've seen at Barclays, for example, is we know they're cutting investment banking jobs. A couple of hundred roles might be up for grabs there. And we also have reporting that suggests that Barclays, along with plenty of other banks, is going to actually what we call bagel a few traders. So
bagel zero.
A zero, yeah. So if you're an underperformer,
big fat zero.
Exactly. So that is obviously a big message being sent to, which would be sent to those people. But yes,
But is that a message? I mean, when you get zero bonus, is it kind of, the message of stick with us, we're just going through tougher times, or we need to prove something to shareholder, or is it, thanks so much?
Yeah, I think your surplus to requirements is how at least I would interpret that.
It's us, not you.
I think, it's not a great look. I mean, even in the UK, where you have a much higher fixed salary to bonuses are still big chunks, huge numbers we're talking about. And I think, any sort of self-respecting trader, if they were bagel, as it were, would at least be looking for other opportunities.
Yeah. Tom, very quickly, I mean, we used to talk about what Goldman Sachs, unlimited vacations, is that no one ever takes, but is there something that they can offer in return?
I think
free energy?
No, I think ultimately for these traders who are in the office 5 days a week, they have to take a certain amount of holiday. I think it all comes down to the money.
All right, there you go. Tom Metcalf, they're our resident banker whisperer, joining us, of course, on everything. On bonuses, now let's also take a look at some of the things to watch out for this week. Today, EU finance ministers meet in Brussels, where EU sanctions on Russian fossil fuels and the cost of living are likely to top the agenda. We'll have plenty of data from the U.S., including factory orders, durable goods orders, and the ISM Services Index. Tomorrow, we'll have the latest policy decision from the Reserve Bank of Australia. Also, Democrat Raphael Warnock and Republican Herschel Walker face off in Georgia's tight U.S. Senate runoff. On Wednesday, we have rate decisions from Brazil, Canada, and India. We also have Euro area GDP reading. Thursday, U.S. initial jobless claim are released. We hear from François Villeroy de Gallo of the ECB. And then on Friday, we'll have plenty of data on China, including CPI and PPI. Woo! What a week to get your energy up this Monday. More Bloomberg Surveillance Early Edition is up next. This is Bloomberg.
biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
City, in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Once again, Fed communication has contributed to undue volatility in markets.
We got a long way to go to getting inflation down where the Fed has said that it wants it to be.
There is a slowdown coming through, and I think the Fed is acknowledging that, and that's part of the reason why it's talking about moderating the pace of hikes relatively soon.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Backing away from COVID-0, China eases testing requirements in major cities across the country. OPEC and its allies hold steady. They decide to keep oil output unchanged in the wake of market turmoil and uncertainty. And Saudi Arabia's Crown Prince Mohammed bin Salman reportedly is set to invest in Credit Suisse's new investment bank that has shares rising in early trading. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it seems that once again, the Asian equity session, sentiment lifted there by China reopening stories, but that's not really filtering through into the global narrative.
Yeah, it may not be spreading across the globe, Anna, but it definitely was a stark move in Asia overnight to the upside. The idea that COVID-0 policy is starting to ease, with testing requirements easing over the weekend in cities like Shanghai and other places around the country as well. So that sent stocks up much higher overnight. MSCI Asia Pacific Index as overall up a little more than 1%, but really the outsized moves coming from Chinese equities that are listed in Hong Kong. The Hang Seng China Enterprise Index was up more than 5%, and tech stocks in particular up 9.3%. That Hang Seng Tech Index now at its highest, going all the way back to August. Meanwhile, for the Chinese yuan, it is at its strongest going back to September, breaking below that 7 per dollar level for the first time in about 3 months. 694.59 is where we trade on dollar offshore yuan at the moment. And then in the commodity complex, you are seeing some gains spurred by the fact that Chinese reopening demand fuels the optimism around the demand story. So iron ore up a little more than 2%. We're trading at $108, which also is the highest level going back to August, Matt.
All right, so we're looking here at futures that are actually down. You'd think the China reopening story, as Anna said, would spur bullishness around the world, but it certainly hasn't here. It looks like equities investors, at least in futures right now, are focused more on the Fed's rate path than they are on the possible demand that would be created by the reopening in China. So we do have a drop here, and we didn't actually have a big drop on Friday. So it seems like investors have spent the weekend kind of reassessing what they thought of the jobs number on Friday. But Larry Summers and a number of others have called for higher rates than the market is currently pricing in. So that could be what's happening here. The 10-year yield up a little bit, not too much though, almost 3 basis points. 351.33 is the level on the 10-year, although there are a lot of strategists saying, look, if we're going to go to a Fed funds rate of more than 5%, we need to be higher than 350 on the 10-year yield. NYMEX crude is where you see the China demand coming in, to some extent rising about 1.8% right now, 81.43. Of course, Brent is rising as well. And of course, we have other oil stories, what OPEC is planning to do, what the Russians think about the European oil cap, which has actually been set at a higher level than they're paying for oil right now out of Russia anyway. And then Bitcoin right now up a little bit more than 1%, $17,315. So back up above that $17,000 level after the terrible month that November was for certainly centralized exchanges. It doesn't look like it's hit the underlying asset too hard. Anna, what do you see in terms of European stocks and markets?
Yeah, we'll certainly get more on the Bitcoin story and decentralized finance later in the program, another conversation about that. Matt, this is what we see for European equity markets, a mixed picture, flat to negative actually for most of these markets. The London market proves itself to be a little bit more resilient because of basic resource stocks going higher. We've got iron ore prices are higher, oil prices, Matt set out, those are higher. But perhaps that points to the negatives also for Europe, because if the China reopening story is going to quickly lead to higher commodity prices, then this is not a great time for Europe when it comes to commodity prices, given how stretched the gas story has been, dependent on the weather, of course. Brent crude is then at $87.09, 1.8% higher than previously. As Matt was saying, there's so much going on here. OPEC Plus deciding not to change their output plans, but there's a lot to talk about. There's the reopening in China. That, according to Amrita Sen, is the biggest driver of oil prices, and she thinks that pushes things higher at the start of next year or into next year. This is the gas price then, up by 3%. And I put this in here as an excuse to mention the story around Trafigura. So the German government has signed a loan agreement with the commodities trader Trafigura, and in exchange Trafigura promises to send a substantial amount of their US LNG product to Germany. And this is interesting politically, the way that Germany is setting itself apart here and doing a deal on its own, and it's interesting in terms of the market dynamics. The gas price in Europe then up around 3% today. Vodafone is up around 0.5%, and I put this in because the CEO is leaving. The stock is actually down 44% during his tenure, and so after 4 years Nick Reed is going to be leaving that business. Credit Suisse up 7%. We mentioned this in our headlines, Matt. This is to do with whether we might see further investment coming through from Saudi Arabia. It is certainly being talked about in other media, and that is pushing the share price higher. It was higher on Friday, of course, after comments from the chairman.
Yeah, well, I mean, we know that Saudi Arabia already is taking a 9.9% stake in the bank. The question is whether or not, or the reports are that Mohammed bin Salman himself is going to directly invest in the investment bank as it gets spun off. Let's get, though, back to the China story right now. It appears to be shifting away from the strict COVID-0 policy over the last few days. This weekend, testing requirements were eased in a number of major cities. Bloomberg's Tom McKenzie joins us now for more. So, Tom, what changes have we actually seen, interestingly, really, since these protests took place a week ago?
Matt, I think you're right to focus on the protests. It's really fascinating that that outpouring of anger that we saw last weekend has appeared to move the dial. At least it's accelerated this shift by authorities and the officials in Beijing to put in place some real material changes. They haven't completely given up on COVID-0 yet. That may well be coming, but they have made material changes. For example, entering shopping malls, entering restrictions. You don't need to prove that you've had a COVID test. In fact, they've been removing a lot of the COVID testing facilities in some of these key cities, like Shenzhen, like Guangzhou, like Beijing, like Shanghai, and that continues. It's worth pointing out that there are still major parts of the economy that remain closed off. For example, the schooling system remains shut in large parts of Beijing. There is still a closed-loop system, for example, for factories like Tesla producing those cars just out of Shanghai. But these are significant changes, and of course the markets have reacted to that. Goldman Sachs saying they now expect fully a removal of these COVID-0 restrictions by April of next year, Matt.
And Tom, I know that we've done a survey of economists who, similar to that timing, are talking about the second quarter of next year, aren't they, for the lifting of the COVID-0 measures. So what is stopping China from reopening more quickly?
Yeah, a couple of factors. And again, you could describe these as own goals, arguably. So not allowing the import of mRNA vaccines, so Pfizer and Moderna, that we know are so efficient at reducing at least the transmission, at least the hospitalization and death rates. Those have been blocked so far by Chinese officials. We'll see if that changes. The relative low vaccination rate of the older population, particularly the above 80s, that is a factor as well. And the healthcare system as well. They need to ensure that the healthcare system is ready for a tick up in rates in terms of infections and hospitalizations. The other thing to watch for is there's the Politburo meeting in the next few days, and there's been reporting from others, suggesting that you may get additional measures come Wednesday of this week. So watch for that as well in terms of further concrete measures on COVID zero out of Chinese officials.
Okay, Tom, thanks very much. Well, we'll look for that on Wednesday then. Tom McKenzie with the latest on China. Now, China's reopening is pushing oil prices higher. I spoke with the Energy Aspects co-founder Amrita Sen earlier on her predictions for oil in the next year earlier.
Just last week, you've seen 17 million barrels of draws across US, Japan, and ARA. So draws are picking up as the SPR slows down. And yes, Europe and US will slow down. It's already in our numbers. But again, China and Asia picking up the baton will just create a lot bigger deficit. So some volatility in the near term, but then upward trajectory for oil prices should resume from next year.
Paul Wallace joins us now, Bloomberg editor for energy and commodities. Paul, good to see you. So how does the China COVID outcome then set us up for a rally in oil prices?
Hi, Anna. Well, that is definitely the main driver of oil prices right now. I think what we've seen in the last week is
All right, it looks like we're having a little bit of a difficulty there in terms of the audio. We're going to try and hook that up again and get back to him right now. But I want to get to the Credit Suisse story that Anna had mentioned earlier. Saudi Arabia's Crown Prince Mohammed bin Salman is preparing a direct investment in Credit Suisse's investment bank, according to the Wall Street Journal. Marion Halftermeyer, our Swiss banking reporter, joins us now for the details. So, Marion, it doesn't seem as though Credit Suisse really has a problem with Mohammed bin Salman and his money in terms of investing in CSFB.
No, not necessarily. And they've come out and said, look, that they welcome, diverse investors across the globe. They do have a broad base of investors. I mean, one of the other big shareholders is David Harrow of Harris Investments, for example. So it's not necessarily problematic from them. I do understand that people have raised this sort of geopolitics angle to it. But I think at this moment, they're just looking for strong backers with long-term money, and the Saudis are providing that.
Who are the other potential investors we should be keeping an eye on as well, Marion?
That's the tricky question. So there's two things going on here. We have the capital raise, which is obviously it's coming to a close at the end of this week, which we will see probably some of their main key investors, so the Saudis, the Qataris, David Harrow, as I mentioned, reappearing as large stakeholders. And then you have the separate part, which is the Credit Suisse First Boston, which we're still trying to figure out, and they are themselves trying to figure out how they're exactly going to carve this out and what kind of equity ownership model they're going to have. I think Credit Suisse wants to keep a significant stake in that business, and they also want to create a partnership model for their main MDs, the main deal makers in the business. So you'll see Michael Klein come on as CEO. He's obviously a phenomenal historic deal maker from his time at Citibank. So he might take a stake, and then some of the other leading bankers will take some kind of a stake through the equity partnership. Then they're also looking for the outside capital, particularly for the leveraged finance business. So you might see any number of institutional players come into play. For example, we did see Apollo and PIMCO and a number of other banks looking at the securitized products group. So there's definitely appetite out there for pieces of Credit Suisse. It's just going to take a bit of time to figure out what that structure is going to look like.
Yeah, and the market increasingly pricing that in, up 7.5% then for Credit Suisse shares this morning after Friday's rally. Marion, thank you very much. Bloomberg's Marion Halftermeyer with the latest on Credit Suisse. Let's get back to the oil story. Paul Wallace, Bloomberg editor for energy and commodities, now fully on mic, I understand. Paul, you were telling us about how reopening in China is going to impact on oil prices. Amrita Sen certainly suggesting to me earlier that this was going to be the guiding factor early next year.
Yes, I think it's the guiding factor right now with oil prices rising slightly today, and yes, early into next year as well. This was the thing that oil markets had really been waiting for, this reopening of China, which could lead to a huge rise, a big rise in oil demand there of anything around 2 million barrels a day. So if China is intent on reopening quite quickly, and a lot of oil traders think that the signals from the last week or so suggests that, then yes, that could put more pressure on oil prices given how tight we are. The suppression of oil demand in China over the last year because of COVID-0 has really weighed on crude prices.
Well, and of course, the other oil story we have to consider is that EU sanctions on Russian oil start today. The bloc also has agreed to that $60 per barrel price cap. We just heard from the Kremlin, a headline coming out that Russia is preparing its response to the West oil price cap. Do we have any idea what that response could look like?
We have to wait and see, and I think even Russia itself will be watching to see just what the effect of this price cap will be on its exports, because even Russia doesn't know. I mean, these tightened sanctions and this price cap are pretty much unprecedented in the oil market. Russia has said very clearly that it is prepared to cut production and cut exports if would-be buyers are trying to impose this price cap on it. The good thing for the global market, and especially oil importers who want lower prices, is that the cap has been set at a level that is below where Russia's main grade is trading at the moment. So there are a lot of analysts out there that think it will be business as usual, but the jury is still out. One big thing to watch is what happens with Russia's exports from its east that typically go to Asia. Those could be disrupted.
All right, Bloomberg's Paul Wallace in Dubai. Thank you so much, and thanks for bearing with us through those technical difficulties. Now let's get back to the U.S. markets and take a look at some stocks moving in pre-market trading, and a lot of them actually tie back to the China story that we were discussing, the optimism around the reopening of that economy. That lifted Chinese technology shares in the Asian session, and it's doing the same in the pre-market session here in the U.S. when it comes to some of those ADRs. The likes of Alibaba and JD.com and Baidu all higher to the tune of 5% plus in pre-market trading. You also have the read-through into some casino operators that have big revenue exposure to Macau, and I'm talking 50 to 60% of revenue coming from that gambling enclave. Las Vegas Sands, Wynn Resorts, MGM, all higher to the tune of 2.5% to even 4% in the case of Wynn Resorts. The idea being that if you have easing of COVID restrictions, more travelers from the Chinese mainland can make it to Macau. Finally, a group of stocks moving lower today and just underperforming what we're seeing in the broader future session is large cap technology. The likes of NVIDIA and Meta and Alphabet all down in the ballpark of about 0.5%. So the rate story obviously a big factor when it comes to some of those high multiple technology stocks, Anna.
Absolutely. We'll certainly keep an eye on those tech names then, Kaylee. When we come back, we will be talking to Felix Zulauf later in the program, founder and CEO of Zulauf Consulting. What does he make of the China reopening story? What opportunities are within that? We'll talk to Felix about his thoughts. We'll be speaking with the founding partner of crypto venture capital firm 1KX. That conversation keeping the crypto theme going. This is Bloomberg.
The satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. I am looking at the real Fed funds rate. Now, you could quibble about the definition, but generally, the Fed considers the core PCE the most important measure. So if you take the Fed funds rate and take out the core PCE, we're only 98 basis points away from going positive on the real Fed funds rate. And Powell has said he wants to have this rate positive in order to fight inflation. So that's basically 2 meetings away, right? If they do 50 basis points at each one. The problem is if you look at CPI, then it gets a lot more negative. In any case, let's bring in Simon White right now, Bloomberg macro strategist, to talk to us about how this is going to play out. Because at the same time, Simon, right, it does look like we've hit peak inflation. So that number, CPI or PCE, is going to get smaller and smaller.
Yeah, for sure. I mean, I think that's certainly true. I think we're seeing peak inflation, probably globally as well as in the US. And you know what, if Powell's looking for an out and he wants to basically curtail rate hikes, he can point to the measure you just put there to show that it's back to almost flat. But I mean, is that the inflation rate that people are really paying? Probably not. You know, even headlines probably underestimating inflation a lot of people are actually paying. And is he done enough to really snuff out inflation completely? You know, I don't think so. I think it's going to be like the 70s. It's going to be a much longer play, if you like, to play in 3 acts. And I think we're just coming to the end of the first act. The second act is like the early ending of the alarm, and then the ease too early, and actually inflation comes back a lot higher later in the cycle.
Okay, a story in many acts, and we're only part way through, Simon. So if he wants an out, you suggest that could be where you find one, of course. Markets are still digesting, perhaps, what we saw on Friday with the jobs report, and another hot number. Month after month, we seem to get these numbers that come in higher than expected. I spoke to one guest earlier today from Union Bancaire Privé who was saying that he found areas of weakness, just cracks in the labour market story out of the US. The weakness in the hours worked, some data from the household survey, all of that, he said, showed some weakness. Do you buy that, or do you think it is still an unashamedly strong jobs market?
I think there's a discrepancy here between jobs and people. So the establishment survey, which is payrolls, measures jobs, and the household survey, which is where you get the unemployment rate, measures people. And there's a big discrepancy. So I think there's been an extra 1.5 million or something like that jobs created this year versus new employees. And that's because a lot of people are getting extra jobs. So I don't think that's necessarily a sign of economic strength. I also think it means that you're going to see a deterioration in payrolls much quicker than you are than the unemployment rate. And so if the Fed is paying attention to the unemployment rate, they're actually going to be lagging the cycle, and therefore the Fed pivot, when it happens, I think could happen sooner than the market expects and also be much deeper than the market expects.
Okay, many definitions of real rates and inflation, many definitions of what's going on in the labour market then, it would seem, depending on the data you look at. Simon, thank you. Bloomberg's Simon White with the latest on the markets. And for more market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
The world like Bloomberg.
My team thinks 2023 we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Chinese now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The founder of the collapsed investment firm Archegos Capital Management wants fraud charges against him tossed out. A lawyer for Bill Wang accuses U.S. prosecutors of engaging in deceitful conduct in the early days of the government's probe. A motion to dismiss the indictment against Wang says he was duped into assisting the government. He is set to go to trial next October. In South Africa, lawyers for President Cyril Ramaphosa are preparing a court challenge against an advisory panel report that said there may be grounds for his impeachment. At issue is the way Ramaphosa handled the theft of at least $580,000 at his farm. A spokesperson for Ramaphosa says he will not quit and will seek a second term as leader of the governing African National Congress. In the UK, the Rail Workers Union has rejected an offer aimed at ending a strike action plan before Christmas. Workers would have received 4% pay hikes this year and next, but the RMT union says that was conditional on a number of changes, including job losses, reducing staff on board trains, and closing all ticket offices. And the founder of failed crypto exchange FTX says he will testify before a House committee holding hearings on the matter. But Sam Bankman-Fried won't commit to when that will be. He says he has first to learn and review what led to his company's implosion. And of course, Anna will have more on crypto later on in the show, but first, we have to talk about the broader market picture.
Yeah, we do. We'll talk to Felix Zulauf, who's the founder and CEO of Zulauf Consulting. What does he expect to see in terms of the inflation trajectory, commodities, the US dollar? What's his strategy? This is Big Day.
Fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who are making things as important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Backing away from COVID-0, China eases testing requirements in major cities across the country. OPEC and its allies hold steady. They decide to keep oil output unchanged in the wake of market turmoil and uncertainty. And Saudi Arabia's Crown Prince Mohammed bin Salman reportedly is set to invest in Credit Suisse's new investment bank that has shares rising in early trading. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, it seems that mining companies, basic resource stocks and energy markets are kind of convinced by the reopening story out of China. Other assets, though, not so much.
Yeah, well, you could look at it that way. The other thing that I read on the Bloomberg this morning is that other markets may really just be taking their signals or basing their decisions on the Fed rate path rather than the increased demand that would come from a reopened China. It does look like that's what S&P futures are doing right now, down about 0.5%. It should be said that the reason everyone is once again concerned about the Fed rate path is that we got such a strong jobs number and such a strong wage increase in terms of average hourly wages on Friday. And then at the end of the day, the equity index didn't finish much lower at all. I think only about 1/10% down on the day, 1 or 2/10%, still above 4,000. So it does look like over the weekend, as more economists have come out, including Larry Summers, and said that rates may need to be higher than the market is currently pricing in. Investors have decided to sell futures. The U.S. 10-year yield also rising a little bit, about 3 basis points right now to 351.51. And economists and strategists have also said that this number needs to be much higher if we're going much above 5 on the terminal rate as well. NYMEX crude, on the other hand, as you said, getting its cues from the reopening moves that we're seeing in China, or at least the loosening of rules that we're seeing in China. That could boost demand. So we're up to 81.43 a barrel. A week ago at this time, we were down with the 73 handle. So it's a pretty significant climb. And then speaking of significant climbs, Bitcoin now back up over 17,303. Obviously, there's still a lot of fallout to come from the implosion of FTX, maybe another shoe to drop in terms of more bankruptcies. Nonetheless, the underlying asset doesn't seem to have been hit as hard by the problems in those centralized exchanges. Kaylee, what do you see in terms of the pre-market movers?
Well, a lot of them come back to the China story we were talking about, the optimism about the reopening of the economy. We saw big gains in Asia overnight for that very reason, and that is trickling through to some of those big Chinese technology companies that are listed here in the U.S. The ADRs of Alibaba and Baidu, for example, and JD.com all higher by about 5% in early hours. The other group of stocks moving significantly higher, where outpacing, far outpacing what we're seeing in the broader market is casino operators, because of course the likes of Wynn Resorts and Las Vegas Sands and MGM all have heavy revenue exposure to Macau. It makes up, in some cases, more than half of overall sales. So as a result of the idea that more Chinese mainland travelers can go to Macau and gamble, it's lifting the likes of Wynn Resorts and Las Vegas Sands by 3 to 4% each, Anna.
Yeah, so clearly the China reopening story having an impact there, Kaylee. Here in Europe, it does have a bit of an impact when it comes to the basic resource stocks, the mining companies. They're all trading higher today, and that limits the downside perhaps, but the downside winning out just, and we're down by 0.1% or so on the European markets on the stock 600. Brent crude, Matt's already been through the WTI story, up by 1.8% here as well. 87.11 is where we trade on Brent. There's OPEC deciding to wait and watch and just keep an eye on what's happening in this market. There's a lot changing with the China reopening story. On the other hand, Europe saying it doesn't want, of course, any seaborne cargoes of oil from Russia, and it puts a cap on the price of that oil for the purposes of European insurance and for transportation. So that's a complicated story. And our contacts, talking to our colleague Maria Tadeo in Brussels, saying you just have to wait and see how this is going to play out. The natural gas price up by 2.8%, and I put this in as an excuse really to talk about the deal between Trafigura and the German government. It's an interesting one. The German government doing its own deal with the energy trading business Trafigura, and this means that they are going to be, Trafigura benefits from a loan backed by the German government, and in exchange they agree to supply substantial amounts of their US LNG supplies to Germany over the months and the years ahead. Credit Suisse is up by 6%. We mentioned in our headlines that there's been this other reporting in the media around whether Mohammed bin Salman is going to make his own investment in the business. We know that broader Saudi infrastructure or bodies are going to be making an investment. Whether he will also be adding his name to the investment roster, if you like, those anchor investors, is a crucial one to watch there, Matt.
All right, we'll definitely keep an eye on that. And speaking of Swiss banks, let's talk to Felix Zulauf right now. He's the founder and CEO of Zulauf Consulting, has been for decades a member of the Barron's Roundtable, and also used to work at some Swiss banks in a number of different cities around the world. Felix, great to get you on the program. Thanks so much for joining us. Let me first get your take on what we saw on Friday here in the U.S. in terms of the non-farm payrolls number, and especially the increase in average hourly earnings. What do you think this means for the Fed and indeed other central banks that need to take their cues from the Fed in terms of a terminal rate higher than 5? How much of a problem is that for global markets, for risk assets?
Well, obviously, the U.S. is in a very special situation, because the U.S., like no other country, has still a fiscal pipeline that has nourished the consumer, that the consumer can hold out much longer. And that's the problem for the Fed. Obviously, the Fed has increased and hiked rates quite aggressively, and that is impacting all those rate-sensitive sectors like housing and automobiles and things like that. But the demand has jumped over to the service sector. And if they want to kill the service sector demand, then they have to go much higher. I do believe, however, there is a global influence of the U.S. economy, and I think the world economy is in much weaker state than the U.S., and that will remain the case. Maybe the U.S. will have a mild recession in the middle of next year, but I think Europe and China, they are in a very serious and severe recession for the first half of next year. So I think the Fed has to probably watch what's happening in the other parts of the world, because they cannot overdo it. There are too many problems with on the financing side in many countries around the world with too strong a dollar.
Okay, so you think the rest of the world is looking at potentially a more severe recession than the U.S. economy, and yet there is this narrative in markets that the Fed is going to be forced to pivot back toward easing at some point, that economic forces are going to mean that they turn the other way. When do you anticipate that will happen, Felix?
I think only once we see the U.S. economy clearly weakening, and I do not expect that before the second quarter. So I think the first quarter will be a big disappointment, because you won't see the pivot people are expecting, and that's why I think the markets will have another sell-off in the first quarter, and then probably complete the cyclical correction that we announced about a year ago or so.
Okay, so you think that we have further to fall. So where will you be looking for the entry point, Felix? What signal are you looking for?
Well, the ideal thing would be a credit event sometimes somewhere in the world, and obviously China is a big candidate that we have credit events in China. That would rock the world because China is so important, and I think that would signal the Fed that it has to go slower, and that would give us the pivot that many are looking for.
Let me ask you about what's going on with the dollar, Felix, because one of my colleagues brought to my attention a chart that showed the Bloomberg Dollar Index has actually erased 50% of its gains from 2022, which suggests we've seen quite a retrenchment in that strong dollar story already. Are you buying that? Do you expect that to continue?
I think what we have seen is a short-term correction, and we will probably see a big bounce in the first quarter, close to the highs that we have seen before. That would then probably most likely complete a top, and then the dollar could decline for the rest of the year 23. But I think from here it's not much down. We have corrected quite a bit, and the market is getting very oversold. And I think there will be a disappointment in the credit markets because I do believe that the bond market yield has declined a lot. And there are huge amounts of treasury issuance ahead of us. And there is, you know, the normal buyers, they are full already. They have allocated their amounts, and there are strong sellers. There is the treasury is a big seller. The central bank is a big seller. Foreign central banks are a big seller. And therefore, I think we will have a swing back in the bond yields in the next few weeks.
Okay, is that going to weigh on demand for corporate debt then? Is that the link you're making?
Well, it affects also the corporate sector. The corporate sector has been borrowing quite heavily recently in different regions of the world, but I see that rather as financing higher prices in their working, and also financing increasing inventories, which are accumulated in an involuntarily way. So I think the corporate credit demand will loosen up once we will see that the final demand is beginning to weaken somewhat after the Christmas season.
Felix, I want to get your take on China. It had been called quite often this year uninvestable. On the other hand, investors, you know, are almost as excited about the reopening of China as they are about the possible pivot of the Fed. Is it going to happen? Do we see it happening right now? And is China, you think, a must-have for institutional investors in their portfolios?
Well, China is loosening some of the restrictions, and that will over time have a beneficial impact. But what China cannot do, and I think where most of the analysts and economists are wrong, is that China cannot stimulate the economy dramatically because there are boundaries, and the boundaries are primarily their balance of payment system, and particularly the banking system. You know, the credit system is not in a position to finance high growth. The high growth of recent years, before they slowed down, was really at the margin foreign funding. And the Chinese do not want to depend more on foreign funding, and they are actually even trying to pay back US dollar denominated debt. And therefore, the Chinese are not in a position to really go full speed in stimulating the economy. If they did so, we would have a serious currency crisis like in 94 or so, where the renminbi would plunge sharply and where it could trigger off a major crisis in Asia. And I think China does not want to do that because it could backfire in trade and backfire also in politics.
Okay, so you don't think we're heading there. Felix, thank you very much. Thanks for joining us. Felix Zulauf of Zulauf Consulting. Coming up on the program, Lars Clausen joins us, founding partner of crypto venture capital firm 1KX. What kind of appetite is there for putting money into crypto startups right now? We'll talk about that next. This is Bloomberg.
hydrogen has a very special place in the universe. It's the first element on the periodic table. It is the most abundant element in the universe. And when clean energy advocates think about what can we find which would be as easy to use as fossil fuels, they think about hydrogen. The fuel that will, when burned, only produce water.
We like to imagine that if we just built enough of these and these, we could ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need good old-fashioned combustible fuel. Now, startups around the world are betting that hydrogen can become the fuel of the 21st century.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I mean, there were explicit mechanisms by which there was allowed borrowing and lending on the platform. But I completely agree that it is, in general, like a huge warning flag. And I thought that we had, processes in place that were managing it. I didn't do nearly as much diligence on that as I should have.
That was Sam Bankman-Fried speaking in an interview that aired on ABC this week yesterday. Meanwhile, Bankman-Fried says he will testify before Congress once he has finished learning and reviewing what happened. He says he's not sure that will happen by next week when the chair of the House Financial Services Committee invited him to join a hearing scheduled for the 13th. Joining us now to discuss more of the FTX fallout and the latest in crypto is Lasse Clausen. He is founding partner of 1KX, which is a crypto venture capital firm. Lasse, thank you so much for being with us. Clearly, we continue to see the ripple effects of the downfall of FTX. How has its collapse affected your portfolio companies?
Hi, everyone, and thank you very much for having me. So I think we had a stronger overall market reaction in the spring when we had the first shakeout of some, under-collateralized centralized finance players. I think the FTX story on top hasn't had that much effect overall. Also on prices, I was actually quite surprised that with a calamity of this magnitude, that Bitcoin didn't go down to 5,000. So overall, FTX fallout on prices hasn't been that dramatic, and then particularly on our portfolio has been very, very limited. We did a survey, we talked with our portfolio company, and none of them was actually directly involved. One of them used to have Alameda as a market maker, but the relationship had already ended.
Okay, and last, one thing we know is that FTX drew in big venture money, and I'm wondering, as a venture capital investor, how this may change your thinking about what you want to invest in, and frankly, how you conduct due diligence in this space.
Yes, so I want to, tread lightly here, but there were some very, very obvious warning signs about FTX Alameda from day one. We looked at this back in the day, and, you didn't have to dig too deep to basically know that half the team was a hedge fund that was trading on its own exchange. So that's already a huge, warning sign. And so, we and a lot of other earlier sort of crypto investors abstained from investing in FTX. I think overall, and how it affects our portfolio and our way that we make investments. So I would say actually not at all, because what is very, very important, I think, to differentiate that FTX itself wasn't in effect really a crypto business. FTX was just a normal exchange, centralized exchange. We've had this business model before that happened to sell digital assets, but it might as well have sold, soybeans or, stocks. In our view, really the innovation of crypto and a blockchain is computer, internet, software infrastructure, but that is completely open source. Now, what does that mean? That, every single line of code of the entire system is completely transparent. Anybody can, at any time, see what is the logic, what are the possible operations. You get mathematical guarantees that operator fraud is impossible the way it is. The way that it happened with FTX is technically impossible in the kind of systems that we invest into. And on top of that, you have 100% transparency. So at any moment, anybody in the world can verify where the funds are and if they're moving or not. So we continue to invest heavily in that. We believe, and actually, you can make the point that FTX is another endorsement that we actually need these systems where you don't need to trust people or institutions, you just need to trust the math.
Lars, what do you think about the state of regulation in the U.S.? I mean, since the implosion of FTX, we've heard a number of people come out and say you could run this business in the U.S., on traditional regulation. You can't commit fraud here, and you shouldn't do it in the Bahamas as well.
Yeah, so I think, there was also a very obvious thing that FTX didn't get audited, right? So that's a big one, that you just have, reputable third-party auditors once a year. And I think overall, the traditional centralized businesses, such as centralized exchanges, but I also think centralized stablecoin issuers, I do think they need to be regulated. So in our view, if it's not open source, it doesn't need to be regulated. So sometimes the industry gets the reputation that, it's very anarchist and nobody wants any type of regulation. We definitely very much look forward to, specific modernized regulation that covers particularly centralized exchanges and stablecoin issuers, because, those have or propose systemic risk, and for the industry to move forward and regain the trust, we do need regulation.
If that's the case, Lars, good morning to you. Why does so much of the business want to locate in areas that seem to be off the beaten track or off-piste in some way? In parts of the Caribbean, maybe in low-tax jurisdictions. If regulation is not such a threat, then why doesn't the industry just come and locate in London and New York?
Yeah, so I think at this point you don't have regulation. You basically have a gray area, and everything is up to the interpretation / jurisdictional sort of land grab of the two main regulatory bodies. Maybe the SEC has been doing that more through selective enforcement action. And so what happens is that you basically need to build individual relationships with the regulator. You need to have meetings, but in the whole process, you don't have any certainty of what the outcome is and what the actual risk that you're taking. And if you think about it as an entrepreneur, the hard part is actually creating a product that is valuable and useful to users. You can't spend 95% of your energy on working out with regulators whether this individual piece of your product will be allowed or not.
Lars, great having you on the program. Hope we can get you back soon. Lars Clausen there of 1KX talking to us about crypto. Tune in, by the way, to our dedicated Bloomberg Crypto program. That's every Tuesday at 1 p.m. New York time, 6 p.m. in London. It's our weekly show that covers the people, the transactions, and the technology shaping the world of decentralized finance. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, Mike Wilson of Morgan Stanley has seen enough of the recent rally he predicted. Joining us now with more is Kriti Gupta in London to explain why he says he is a seller again. So we give him credit for predicting this rally. Kriti.
Well, he's been a bear for quite some time, and even the rallies that he has predicted, he said they're bear market rallies. This is not really indicative of some sort of long-term turnaround, and here he is bearish again, saying this time the trigger for that was simply the S&P 500 bouncing off of its 200-day moving average. This is significant because if you put it into context, what's important about Mike Wilson's call is that he said actually there would be some sort of pivot just a few weeks ago between this kind of macro Fed-driven story to the earnings picture, but as he saw that weaker corporate earnings story, he really changed his tune.
Well, what's interesting, Kriti, is he was lonely for a decent part of this year in being such a bear, and now it seems like everyone has come on over to his camp. It's not just him that is predicting more declines in the first quarter of next year.
Well, he's been lonely for a couple of years, Kaylee. Remember, he was the most bearish of them all on Wall Street. But to your point, yeah, he's now really out in front, and he is coming and leading the consensus story. Binky Chadha over at Deutsche Bank is just one example of that kind of story where they're saying there could be a little bit of a bounce going into December. Call it a Santa rally, if you will. But even in 2023, we are still headed for more pain in the equity market.
Ties in with the conversation we were having with our guest, Felix Zulauf from Zulauf Consulting earlier on. Kriti, thank you. Interesting to see European stocks, and good to see you in London, by the way, including dividends, are back to pre-Ukraine war levels, which is an incredible bounce back for European stocks. And even if you exclude those dividends, we're not far away from bouncing back to those pre-war levels. Thank you very much to Kriti Gupta for joining us on set here in London. That is it for Early Edition. Surveillance is still ahead. We'll hear from Ron Temple of Lazard Asset Management, among others. They'll get you set up for a busy week of data this week. This is Bloomberg.
go wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Are going to continue to rise. They're going to rise throughout next year.
Recession is our base case. That's going to mean more cuts will happen in 24.
The Fed is going to keep at it until the labor market cracks.
We need to see that wage growth come down.
What matters is a wage price spiral.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Equity futures negative 0.5% on the S&P. TK, I think we need to start Friday before we kick off with Monday. We need to go back to Friday and the resiliency of this equity market in the face of another upside surprise in a payrolls report.
And you see it in the reading over the weekend, the writing over the weekend of everybody microanalyzing forward, this stage out to here, then that stage and that. I agree. Go back to Friday and look at two job reports. Some people say it was pretty darn good, like Ferroli at JP Morgan. Others go the other way, maybe some grimness to it. And then the markets into the afternoon showed that resiliency.
If I told you the data ahead of the release and asked you to guess the equity market move, you might have guessed the direction, not the magnitude, down just 0.1% at the close. City Stuart Kaiser, Tom, calls this stubbornly positive sentiment. What do you make of that line? Stubbornly positive sentiment.
74.75 was my first time. I could barely shave. You know, you didn't see the bull market coming, then up to 81.82 and on. Who sees a bottom of a bear market? You don't see it. Is this it? I'm not willing to say that. That's not our job. But I'm saying the bears' heads are spinning here on a 12-month trailing basis, even some green in the screen.
You know who sees the top of the bear market rally? Mike Wilson of Morgan Stanley.
That's an important note.
Salah
because
again.
With respect, that's an important note.
He's been nimble over the last month.
Nimble.
Salah again
So is England.
in the equity market. Watched the World Cup over the weekend.
Of course, yeah.
What do you make of that?
I watched for 5 or 6
Kylian
minutes.
Mbappe for France. That
He's
guy is just like ridiculous.
I haven't looked at my bracket yet, but I would say that I love the way he comes down the ice like it's just great. You know, he's out in the wing and he goes
so
straight
graceful.
down. Yeah. And he's a big guy. I mean, for that size.
He's 23 years old.
It's something, but, you know, let's talk about it right now as we're here. Lisa's not here to tell us to shut up. But the basic idea is, hey, Jude.
Jude Bellingham.
Don't let me down.
Hey, he's fantastic. 19 years old, Borussia Dortmund, just an awesome football player. So composed at such a young age.
And it's a reason for people like me to watch the World Cup, just to watch that one guy at midfield do the magic.
France versus England coming up a little bit later this week.
Saturday.
Looking forward to that. Get that in the diary.
I called Alan DeCosse up and I said, could you possibly have a chair for me?
I know someone's birthday coming up this weekend too.
I don't know.
Who's is that? Equity futures right now on the S&P 500, negative 0.4%. We'll do a little get together and World Cup
England,
viewing,
France.
maybe. Equity futures negative, yields up by a couple of basis points, 351.15 on a 10-year. Euro dollar 105, Tom, 105.33.
We got to go to the data here before we bring in Ron Temple, John. There's important data this morning. It's not a sleepy December Monday, and it's about the yield space. We've got some great guests coming up on yield. John, 2's10 comes down to negative 81 basis points. The real yield made a threat to go to 0.99. It's at 1.07. I'm seeing yield dynamics here that are of note.
Next week. That's the big week. This week, I've got to say, Tom, let's just admit it, this week's set to be a bit of a snoozer. Quiet period for the Federal Reserve this week already kicks in. Next week, you've got CPI and you've got a Fed decision. So CPI on the 13th, Fed decision on the 14th.
Okay.
And the runway this week, let's just say there's not many big things on a schedule.
Right, but it's a time to think and recalibrate. And one of my themes this morning, folks, I've never seen so much overthinking about this pivot, then that pivot, then that pivot. And what's great is Ron Temple doesn't know how to spell pivot.
We've been too cute about 2023.
Way too cute. Way too cute.
Okay.
Way too cute. We've got like 8 things to talk about through the morning here. I think it's great to start with Ron Temple because he doesn't know how to spell pivot.
Let's get to Ron right now. Ron Temple, U.S. equity head and co-head of multi-asset at Lazard Asset Management. Ron, can we start with Friday before we really begin this week, Ron? Because I think many people are still scratching their heads. What did you make of the price action off the back of another big upside surprise on payrolls?
Well, I thought the words you used earlier about being stubbornly positive were pretty accurate. I mean, it basically shows that the market, there's a fear of missing out, it seems, in markets. And in my encounters with investors globally, it feels like there's a lot of hope still that the U.S. can avoid a recession, that the Fed can micromanage this process. And I think people are forgetting that monetary policy is a sledgehammer, it's not a scalpel. And so there's a little too much optimism embedded in markets. And, you know, I don't want to be guilty of being too cute, but I do think the market is ahead of itself in terms of optimism. And when I look at the rates market, I think we're basically pricing in a best case scenario instead of the most likely scenario.
Yeah, well, I look around the best case scenario, and it comes down to earnings and revenue. I've got numbers for fourth quarter of 1.5, dare I say 1.9% real GDP, overlay on inflation, so you get a revenue pop. Does the revenue pop into next year assist the gloom about earnings?
Well, definitely this is a positive for revenue. Inflation actually helps lift revenue, but it also, as you know, it lifts expenses. And I think the margins are going to come down. But the other big piece that's missing next year is I'm in the camp now that it's very difficult for the Fed to avoid a recession. And in a recession, we typically have earnings go down 10 to 15% in a shallow cyclical recession. So I worry that the earnings estimates for next year are still far too optimistic. They've been coming down on the margin, but you know that revenue pop's not going to cover for all the expense pressure. And I do worry for companies, the story next year is going to be all about trying to find those expenses to cut.
And what's critical for me, and a major shout out to Joshua Chafin over at the FT for his commercial real estate article this weekend, which I thought was really definitive. Ron, I'm looking at combinations and transactions now that money it costs something. Are you going to see a roll up next year of a lot of these troubled companies?
I do think actually next year is going to be really interesting in terms of all the different shoes that are going to drop in the market. We still haven't seen the implications of higher rates really hit housing prices. Case-Shiller started to roll over, but it's barely rolled over, down a few percentage points from the peak. We started to see some pain in the commercial real estate space, but not nearly enough. And so I do think you're going to see that pain spread out. Whether it leads to consolidation or other challenges, not very clear, but I do think we're going to see some challenges in the debt markets. They're going to lead to some strategic choices.
Ron, do you think that we need to embrace the companies that are embracing austerity? And I'm thinking of the likes of Zuckerberg at Facebook making a move in the last couple of weeks, a subtle move from Jassy over at Amazon. Do you want to embrace those companies?
I think they're making the right call. I think, especially in the tech space, by the way, a lot of these companies had been basically been hiring and investing for growth, assuming that they could extrapolate out from prior years. They've recognized the reality is that trajectory has changed, and I think they're making some pretty smart choices. And honestly, in any sector where you've had so much growth for so long, you need this period where you pause, you reflect, you reassess what you need, you right size, and frankly, you take some options off the table that just aren't going to pay off. And so I think this is wise, and investors should be looking at these companies carefully and evaluating those choices.
Is it too early to buy those names, though, Ron, given the earnings headwinds that you expect going into the first half of 23?
My view right now on the market is people should basically be taking profits on equities. We've had a great run up in terms of this bear market rally. At 40.70 on the S&P 500, we're trading at something on the order of 19 times forward earnings. And by the way, that might be using a generous E. So I worry that we still have downside. You have to go back almost 20 years to find another sustained period where the earnings yield of the equity market was materially below the yield on a BAA corporate bond index from Moody's. And, you know, effectively, we got an expensive market on the wrong yield. So I would be taking money out of the market and putting the money I have in equities into quality and defensive.
Okay, quality and defensive what? Equities or bonds? Are you going to flip 60-40 on its head and load up on bonds with a lot lighter equity position?
Personally, I think actually the most attractive asset right now, and it's been a long time since I've been able to say this, is cash. I think the bond market is basically too optimistic with a 10-year yield around 350, 355. I think a 4 handle would be more appropriate. When I look at equities, I think we could easily have 15 to 20% downside from here before we hit a bottom. I'm not going to try to tell you which quarter that's going to occur in. I'm not going to try to be too cute.
Thank you.
But I do worry we've got shoes to drop that we'll have to wait for in 2023.
Right.
It's too early. We haven't seen the capitulation.
Does growthiness save me? One final question, Ron. Does growthiness save me? The idea of buying big revenue growth from big tech. You know, we know the usual names, but is that a place to hide, to use that revenue growth over, say, 36 months to protect from the downside you see?
I think what's important in that tech space in particular is to really zoom back out and think about which structural trends still have runway. I mean, for example, migration to the cloud, still a lot of runway. I believe only 30% of U.S. companies have moved to off-premises server, cloud use. The vast majority still doing on-premises servers. And so I look at a theme like that with a lot of runway, and I think there's something that can carry you in the years ahead. The key is getting into these stocks at the right valuation. And again, if the market does decline as much as I think there might be ahead of us, you're still going to have downside in some of these big tech names. So it might be a little early to be jumping in, but definitely some homework to do there.
Hey, Ron, wonderful to hear from you. As always, Ron Temple there of Lazard Asset Management. Like many, Tom, looking for that earnings weakness on the horizon in early 2023.
Yeah, and then the other thing, I mean, 10 days ago, it was like buy the bond market, and we've sort of seen that right now. I mean, the bond dynamic is so important to me. I'm not sure what a negative 81 basis point curve inversion is telling me. I don't know if I'm looking at two. I mean, I need Ian Lingen or someone like that to help.
Never mind what it's telling you. What's it telling Chairman Powell and this Federal Reserve?
Exactly. And again, I'm going to go to this inflation report, and we sound like we're hyping it. Yes, we are, folks. But the fact is the inflation report is more important than the jobs report previous.
And then the Federal Reserve decision 24 hours later, 3-part act. We get the statement, the projections, and the news conference. And the way Chairman Powell's been communicating over the last couple of months, Tom, I think for me and many others, it's how Chairman Powell frames risk management in the presser. What does he choose to emphasize? The risk of under-tightening or the risk of over-tightening? And for many, Tom, just in the last couple of weeks, he seems to have flipped and started to talk more about the risk of over-tightening and not the risk of under-tightening.
Yes, I agree with that, but I also like the mathematics of this word cumulative that we hear from Vice Chairman Brainerd of Wesleyan University. The idea that you just add up these events over time and they have a combined impulse, and I think we've done that. There's been Jackson Hole, there's been this speech, that speech, and the others, and they add up. Have you seen the hate mail we're getting in this morning?
Who from?
We're already, there's some guy in Cambridge, England, who's just beaten up. He's tearing you to shreds. I mean, there's just no other way to. He's got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 evil exclamation points.
You're talking about Mohammed?
I think that would be Dr. Alarian.
Alarian was very upset with the Jets yesterday.
Well, yeah. I mean,
the loss to the Vikings.
Okay, I get it. Let's have some World Cup talk for Mohammed. The basic idea is England, yes. Jets, no.
Did you watch Purdue, Michigan?
Yeah, we have a partial score on that, folks, in honor of George Carlin. Michigan, 43. That's our score.
Boilermakers just collapsed.
You know,
Wolverines.
It's a partial score. You know, we don't talk about Purdue.
Enjoyed that game Saturday evening. Fantastic.
Yeah, well, I was forced to watch it.
Who made you watch it?
Senior executive. Do you know she dresses her children in Boilermaker?
She called Michigan the Spoilermakers.
Oh, she did?
Yeah.
She
Futures
calls
down
me other things.
4/10 of 1%. Live from New York. Great to have you with us to kick off a new trading week. This is Bloomberg.
Keeping you up to date today with news from around the world. With the first word, I'm Lisa Mateo. OPEC and its allies have decided to keep oil production unchanged. The outcome of Sunday's brief online meeting reflects the unpredictability of supply and demand in coming months. OPEC Plus has just implemented the 2 million barrel a day reduction agreed at its last gathering. Meanwhile, European Union sanctions on crude exports from Russia came into effect today. Authorities in China appear to be shifting away from the strict COVID-0 policy. Over the weekend, testing requirements were eased in a number of major cities. The loosening of restrictions comes as China enters a downswing in its latest outbreak curve. Fewer than 30,000 COVID cases were reported on Sunday, the lowest in almost 2 weeks. In the UK, the Rail Workers Union has rejected an offer aimed at ending a strike action planned before Christmas. Workers would have received 4% pay hikes this year and next, but the RMT union says that was conditional on a number of changes, including job losses, reducing staff on board trains, and closing all ticket offices. And the Crown Prince of Saudi Arabia reportedly will be one of the investors in Credit Suisse's new investment bank. According to the Wall Street Journal, Mohammed bin Salman is considering an investment of around $500 million to back CS First Boston. Credit Suisse is spinning off its investment bank as part of a reorganization following scandals and huge losses. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays. Tomorrow, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
Value in diplomacy if the parties in question, and in this case Russia, are actually interested in meaningful diplomacy. And what we've seen, at least recently, is exactly the contrary. Unless and until Putin demonstrates that he's actually interested in meaningful diplomacy, it's unlikely to go anywhere.
Antony Blinken there, the U.S. Secretary of State on CBS over the weekend, live from New York City this morning. Good morning. Here's the price action for you as we kick things off this Monday morning. Equity futures on the S&P 500 down by 0.4%. Yields just a little bit higher by a couple of basis points, 351.15 on a US 10-year. Euro a little bit stronger against a weaker dollar. Euro dollar 105.46. Just remarkable to see the dollar weaker on Friday, Tom, off the back of that payrolls report. Can you explain that to me?
Well, no, I can't explain it. Rebecca Patterson's going to be with us later. We're thrilled to have her on from Bridgewater, where there are decades of foreign exchange experience. I'm sure she's not going to give us the direct challenges that Bridgewater's had in the last 90 days, but the immovable force, and John, you've been out front on this, is a big figure weakness in the dollar, upsetting the certitude of dollar resiliency.
Clearly in the driving seat of last week was just Chairman Powell's address at Brookings. And nothing else. We shook off that data pretty quickly. I wonder if we do the same thing with CPI next week. Need to talk about China as well, Tom, before we move on. New testing rules in places like Shanghai.
Yeah.
So now you don't have to have certain testing requirements to enter certain public venues. Just this idea, another signal perhaps that we're moving away from COVID-0.
I'm going to call it a jumble or mix. Leland Miller, I thought was great last week with Beige Book. But what I'm going to do is look at the Bloomberg folks, and Stronger and Minby, what was it, 7.20, 7.2? We're now down well under 7 yuan per dollar, 6.95 for those keeping score. That's a strong currency, whatever the politics and the medicine is of China.
That's down from 7.32, 7.33 at the start of November. Once again, Tom, the dollar weakness that's come through over the last couple of months is pretty profound.
And again, it's the depth of the system. It's the deepest market out there. I don't know if they got their Bloomberg terminal at the White House and in Brussels as well. I don't know if they're looking at it and look at where dollar is, but we're always looking to these two capitals. Anne-Marie Horton joins us now, our chief Washington correspondent. Maria Tadeo in Brussels as well, medicated and over Spain as well. Well, let's not go there, Maria. Let's go to the seriousness of this war right now. I looked on the Bloomberg, and Kiev is 17 degrees is the low. That's Fahrenheit. Maria, I'll let you take that to centigrade. Do we understand the cold of Ukraine?
I don't think we do, Tom, especially because the situation that the country is in is unprecedented. It's a cold winter, but you also have the infrastructure that has been completely damaged by Russia, and that is the issue here. The country is trying to repair things very quickly, but they get broken down. They have blackouts. They have parts of the country that simply do not have access to electricity, that do not have access to heating, and on top of that, and we shouldn't lose sight of that, it's also pretty cold in the rest of Europe, Tom. Here, this weekend in Brussels, it was minus. This changes everything when it comes to the European consumer. We talked about this mild temperatures, where I have to tell you, anecdotally, I did turn on the heat in this weekend.
Van der Leyen and Stoltenberg and everybody else in Europe has a collective memory or a study of history back to the cold at the end of World War II, maybe those years afterwards, 1947, 1948. This was not fun for those of you not read on this. What is the urgency to do something now about a tangible cold?
Look, there's two things. When it comes to Ukraine, it's about the air defense systems. And I spoke to the Secretary General last week, remember, and he repeated that they need it because otherwise there's just no way they'll get through the winter. The nature of the war has changed. This is not just military. It's not an army that fights another army. This is now about people, millions that could potentially freeze to death in the heart of Europe in 2022. I remember we were told this would never happen again in Europe. When I was in school, we were told this would never happen again in Europe. The symbolic nature of this, it's very emotional, it's very powerful, but this, we should always stress it. When it comes to the rest of Europe, a lot of this has to do with helping the consumer, but of course, if you go big on the fiscal stimulus, there's just also the concern that you are going to fuel inflation, and therefore what von der Leyen does makes life difficult for Christine Lagarde, so it's not easy to balance.
Right, John, I brought this up because over the weekend, I think the American press missed this. It's winter in Europe, and as Maria is living in Brussels, it's colder than normal.
And we've got a price cap agreement as well.
It's noise.
Can you explain that one? Because I can't explain that.
I'm sorry. I just think the American press missed this weekend the level of cold out.
AMH joins us down in Washington, D.C. Anne-Marie, can you walk us through the price cap that was agreed at the European level?
Well, the European Union decided to set a price of $60 a barrel for Russian crude. So if you are a buyer in this market, say India, and you want to buy Russian crude, you have to abide by that cap, meaning you can only buy if it's under $60 a barrel. Now, why this is so important is because in the Russian sanctions package, they said that these companies that have to do with shipping and insurers, and the main block of that have huge amounts of these companies, especially the countries like Greece, Cyprus, Malta as well. So if you want to be able to access the insurers and the shippers to get that crude out of Russia and get it to your port of destination, you have to abide by this cap. So what Russia's saying is they are not going to deal with anyone that deals with this cap. So this is where it's going to become interesting going forward, because right now, a very common grade of Russian oil, Urals, is trading around $50 a barrel. So Russia is going to be very much so on the lower end of this cap where they're trading right now. But in the contracts, our country's going to say, we abide by this cap. And this is where it'll become interesting, because Russia says they're not going to sell to anyone that signs up for the West's cap.
Well, how do you think the Chinese respond to this? The most important meeting of this week is Xi in Riyadh.
Thank you. I did not know this.
December 7th. AMH, can you walk us through what's on the table between Xi and the leadership in Saudi Arabia?
Well, for President Xi, obviously, especially as you have this at the same time over this weekend, more news of them starting to ease some of these COVID restrictions, that could be a huge amount of energy demand coming back in the market from China. So obviously, energy will be, top of the table for Xi and Mohammed bin Salman this week. Also, the fact that China, of course, has been one of these countries that has not come out and condemned the war, and has also wanted to recently put some potential distance between themselves and Russia. The Russian crude that does go to China is much more expensive than the Urals. We're talking more like $70 a barrel, not $50. So potentially Xi is looking for some more longer-term contracts from Riyadh.
That's one to watch later this week. Today, the other thing to watch later this week, tomorrow morning, Morocco, Spain. Maria, can we get the preview from you for the big game this week?
We're going to win 2-1, and I'm in London. I'm already in touch with the Spanish ambassador in London. This is a done deal. We're going to win 2-1. There's no question.
Are you watching with Ferdinand and Isabella? That's what I want to know. Are you watching with Ferdinand and Isabella? Maria, help us here. Can Spain take on the power that I see from France or Argentina? How do they do this against what appear to be stronger, more powerful teams?
What is the question? I don't get it. Why? Because Mbappé scored yesterday twice on an easy game where Poland was all over the place. Argentina, have they actually played a good World Cup? I really wonder.
That's true.
Is this just Messi or a team? And I want to just stress
they lost to Saudi.
I think we get lost in translation here. No. A World Cup. No, this is not about the stars. It's about the team. You need to have a team. We have a team. We're going to win tomorrow, 2-1.
We're going to do a World Cup special with Maria and Anne-Marie. Can you picture that?
Oh, Anne-Marie, with due respect, I just want to see Pharaoh and Tadeo go at it here, folks. That was the real Maria you just
World
saw
Cup
there.
preview with Tadeo. After the Spain game.
You know, I don't want to cast aspersion on the announcers, but to be blunt, I'm watching Telemundo, and the bottom line is, can you see Maria on Fox doing the game?
It'd be fantastic.
She'd be like lights out.
I think just on Spain, though, on no one else. I think there might be a slight bias there, Tom, that might be problematic as the World Cup continues. Maria, wonderful to catch up with you.
I think.
And AMH down in DC at the World Cup. And Spain's big game a little bit later this week.
Yeah,
she's fired up about this,
fired up. I mean, think what she says about us.
On the edge of aggressive about Spain and France.
Yes.
Not impressed with Mbappe at all.
I'm impressed. I mean, I don't know what I'm talking about.
He's awesome.
He's like Salah goes to the goal.
He's just clinical.
And he goes down the sidelines.
Just absolutely clinical. Joining us
you like that, folks?
in a couple of minutes from Bridgewater, Rebecca Patterson. Looking forward to that from New York. This is Bloomberg.
This is last week's team.
lot of the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Equity futures slightly negative across the board this Monday morning. Good morning to you on the S&P. On the Nasdaq, we're down by 0.4% on the S&P. On the Nasdaq 100, we're down about 0.25%. The rally we've had off the bottom, Tom, has been phenomenal. Up by about 13% from October on the S&P.
Maybe I'm wrong. Dean Kern will correct me. 31-ish on the VIX, a lower numbers bullish, down to 24-ish forever. And there we were Friday. And you mentioned this with Ron Temple with an 18 handle on the VIX. And right now, 20.07, an extraordinary statement on this. Can I say bull market? I don't know if I can say
they're still calling it a bear market rally, Tom. You mentioned the Dow and the performance there. You know, I look at the equal weight on the S&P 500.
Yeah.
That rally's been pretty phenomenal.
It has been, and somebody had a really smart tweet out. What about the Dow transports? And this goes back to something, folks, called Dow theory. My mother worshipped it. I didn't. But the answer is, I just think it's one part an odd confluence that the Dow outperforms a better mathematics of the Standard & Poor's 500. But also, I think we need to have respect for quality and large caps. And I really don't know what that means. I don't have a lot of wisdom here off the Lori Calvasino world of small caps and mid caps.
Let's pick up on that conversation about whether this is a bull market or a bear market rally. Mike Wilson of Morgan Stanley's been pretty clear about what he thinks it is. Bear market rally. He's been leaning into that bear market rally. This is what he told us only last week. Take a listen.
We have more confidence that this rally will continue into December. We think rates will go lower. We think, Powell's commentary is right in line with what we've been saying, which is that they're going to pause probably in January. The market's getting in front of that, and this is a classic, kind of Fed pause stock market rally.
It was last week. Just last week. Take a listen to what he's got to say now. As suggested 2 weeks ago, for this tactical rally to go higher, back-end rates would need to fall. Fast forward to today, and that's what's happened. We are now right into our original upside targets, and we recommend taking profits, Tom, before the bear returns with earnest. They are sellers again at Morgan Stanley.
Cardinal rule, I learned this by enjoying losing money. Bond markets lead equity. A guy like Mike Wilson is looking at Turo Patura at Morgan Stanley and really watching the spreads, the dynamics that they see. One statistic, negative 80 basis points of inversion. Tony Dwyer publishes this morning and has a very cautious view as he marks down earnings based off inversion.
And Michael Harnett at Bank of America is saying the same thing. So many people are saying the same thing. First half of 23 is about the bonds, government bonds, in response to a deceleration in growth and poor earnings. And then the second half will be about the recovery in the equity market. Tom, Neil Dutcher of Renmac last week. Got to go back to those comments from Neil last week. He's looking at a re-acceleration in the US economy, confirmed for him by what he saw in the labour market report. And Tom, I don't think I've ever seen this much debate and discussion about where we are, not where we're going, about where we are.
I agree.
It seems to be bizarre that we have this much disagreement about where this economy is right now.
The only distinction here is after this pandemic, these are supply-side mysteries that we have. It's not conventional demand-side analysis. That's in the broader eco-babble, and then you bring that over to what we're all living, and that's the challenge.
We've been surprising to the upside on payrolls, I think, every single month going back to May.
Yeah.
So it's just a long string of them now.
I go back to Jim Glassman at J.P. Morgan, who's been more right on this than anyone. He says, I'm sorry, it's a fully employed America. People are desperate. Let's do this right now. And we really thank Rebecca Patterson for being with us with Bridgewater. She had every reason to cancel after the shock last week of their performance. She is the chief investment strategist for Bridgewater, which was doing so better than good and ran into challenges. Rebecca, without getting into the nitty-gritty of Bridgewater, what were the challenges you faced in the last 90 days?
Well, we take views that are usually 6 to 18 months out. And so as we're looking at the world, we continue to be quite cautious on assets. We think that the market is discounting Goldilocks, that the Fed is going to be able to start easing in the second half of next year without any material hit to earnings and only a very moderate slowdown in the economy. And we just don't think that adds up. And so as we've seen this bear market rally in recent months, the market responding to increased hope that the Fed will pause and then start actually cutting rates next year, we have seen growth assets, risky assets performing well. But we still believe that as we go into 2023, while there is going to be this tug of war, how much will the Fed accept inflation versus force inflation to its target? How much growth pain will we get? We continue to believe that there's another shoe that has to drop, and that is the economy. It's resilient today still, with the exception of housing, but we think the Fed is going to have to push demand lower to get that wage inflation down, and they're not likely to ease next year.
With your years at J.P. Morgan, Bessemer, and now with Bridgewater, tell us about the dollar as the litmus paper of the system. Suddenly, weak dollar. Did that diminish the Bridgewater total return and lead to those quarterly losses? And what is a weaker dollar signal now?
Well, the dollar, as you said, has been giving up a lot of its gains from earlier this year and in the last year or so. We think as long as liquidity conditions remain tight, and remember, the Fed is still raising rates. They may slow the pace, but they're still raising rates, and we've got quantitative tightening, which is double the pace of what we saw in 2018. Plus, we have rate hikes going globally, with the exception of maybe Japan, China. And so these tightening liquidity conditions tend to support the dollar. The dollar is the world's funding currency. So yes, you've seen this sell-off, this technical profit-taking, if you will, on the dollar in recent months, but we don't think we've seen a major dollar top along the lines of what we saw in 1970, 85, the early 2000s. Maybe we're going to be in a bit more of a range over the coming months as we play through this tug-of-war of China reopening and central banks. How much will they tighten? But we don't think we've seen a sustained turn yet.
Rebecca, where do you have the terminal rate at the Federal Reserve?
Well, we're not trying to predict specific numbers for the stock market or the Fed funds. We're trying to understand the degree of pressures on the economy that's going to translate into market outcomes. But certainly, if we need to see wage inflation, which by the Atlanta Fed's measure is still running well over 6%, if we need to get that down 2 or 3 percentage points to get U.S. inflation closer to the Fed's target, then I think we're going to see the Fed going at least to 5% on the Fed funds, with a probability that's not de minimis that they may have to go higher. The trick is, if they get to the spring sometime and maybe pause to give time for Fed hiking so far to play through the economy, maybe inflation comes down to 3-4%. But if the Fed's not happy with that, then they may have to do an additional round of tightening. And we saw that before in the 1970s and early 80s. You needed 3 rounds of tightening for the Fed to actually get inflation under control. The market absolutely is not discounting that possibility. We're not saying it's our base case, but it's certainly a risk that we think is something people should consider.
Your base case sounds like 5. Is that fair? From what I just heard there, is 5 fair?
I think 5 is certainly plausible, okay. and it is very possible we could go higher than that.
So 5's the base case. That's largely what's been priced in the market for quite a while, largely expecting the Federal Reserve to put that in their projections next week. Rebecca, I think a lot of people might sit here and say, well, that's priced. we're done with that. And to get that extra leg of dollar strength, I need something else. And Rebecca, I guess the question is, what is it in your base case that delivers that something else?
I'm trying not to interrupt you because I'm dying to answer the question.
Sure.
It's easy. What's not priced is the Fed going high and holding. The market's anticipating right now that we get significant rate cuts starting in the second half of next year. And we think without severe economic weakness to justify that, we're going to get the Fed pausing but not cutting. And so as that is changed and what the market is discounting, we think that could add a layer of support to the dollar. Again, don't forget, we're not talking about an end of quantitative tightening or rate hikes around the world as well.
You know, I just want to point out, Ms. Patterson never is dying to interrupt me. It's only you she is dying to interrupt.
Do you think that's why do you think that is?
Because, you know, I don't know. I'm just not getting it going.
To be fair, though, it's a good response about the persistence of the Fed staying there and holding
I think just
pushing back against this view that we get these rate cuts from the Federal Reserve anytime soon.
Rebecca and I remember when you made a 6-month call. If you were really, you know, an 18-month call was strange. Now we're going to pivot in January. In the 4th week of February, we're going to pivot again. And then by the 1st week of April, we're going to do this. Forget about it. Rebecca, cash is trash. What is the value of cash to our listeners and viewers into 2023?
Well, what's so interesting, Tom, is that we're really seeing the market move into a new paradigm. We haven't had short-term rates this high in a very long time. And so it is interesting to think about how our investors are going to position for the next decade versus the last decade. The last decade was all about low and stable inflation, low macro volatility, low commodity prices. And now if we're in a regime where there's more uncertainty around the level of inflation, more uncertainty around where interest rates should settle, what's the right portfolio to construct? Should you stay overweight the U.S.? Should you stay overweight tech? How much private assets should you have in your portfolio? We think there's some tectonic plates that are shifting right now, and assuming that they can be sustained, and we think there's a real chance they can, I think we're going to get a lot of more structural, bigger market changes, portfolio allocation changes in the year or two ahead as people realize this is a different world we're moving into. Not that inflation is going to settle at 4 or 5, but it certainly could settle higher than where it's been, with rates higher than they've been as well.
Got to squeeze this in. This is great, Rebecca. Just one final question. What's the biggest change that you're expecting that so far the conversations that you're having with clients, they're pushing back on still? What's the number one change you think we're going to see?
Well, I think the structural change is inflation. I think the cyclical change, the biggest thing to watch for 2023 is growth. I think we're going to have to see growth weaker for central banks to hit their targets, and that's not yet reflected in earnings.
Rebecca Patterson, thank you. Bridgewater, just fantastic.
Thanks.
As always, Rebecca, appreciate it. Looking ahead to next year, Tom, and that view over rate cuts and the Fed standing still. That's the big debate going into 23.
It is. We deal with this every day, folks. We have guests that are just world-class, like Ms. Patterson, and it's simple. They got handlers, and with the news on Bridgewater, it was every ability for them to cancel. I've got, I don't feel good. I overslept because of England football, and there she is out front on a Monday speaking for the
Well, clearly caught offside because what's worked this year? What's worked this year? Rates up, dollar stronger, equities down.
Yeah.
What's reversed in the last couple of months?
As she
All
said,
three.
All
three.
I guess they come back. I mean, that's what it is. To me, the entire thing of next year is all of a sudden money has a cost. That's what's changed.
We've got to talk about the ECB as well in the mix with regards to that.
I'm interested. When's their meeting?
Their meeting's the 15th, the day after the Fed. Up next on this program, Gabrielle Makhlouf of the Bank of Ireland and the ECB. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The price of oil is rising today. OPEC and its allies have agreed to maintain production at current levels. Meanwhile, European Union sanctions on crude exports from Russia came into effect today. And China is tentatively easing the COVID measures that have eroded its fuel consumption. Iran has suspended the operations of the so-called morality police, whose actions sparked massive protests. For years, the police unit stalked Iranian streets, arresting those it claimed were flouting strict religious dress codes. It was blamed for the death of a 22-year-old woman who fell into a coma after being detained for her attire. Congress may get rid of a coronavirus vaccine mandate for those serving in the U.S. military. It's a compromise designed to win Republican support for an $800 billion Pentagon spending bill. House Republican leader Kevin McCarthy told Fox he has worked out the agreement with President Biden. White House officials told the Washington Post that nothing has been resolved. In South Africa, lawyers for President Cyril Ramaphosa are preparing a court challenge against an advisory panel report that said there may be grounds for his impeachment. At issue is the way Ramaphosa handled the theft of at least $580,000 at his farm. A spokesman says Ramaphosa will not quit and will seek a second term as leader of the governing African National Congress. And it's another sign that demand for Teslas in China isn't living up to expectations. Bloomberg's learned the electric car maker plans to lower production at its Shanghai factory. It's estimated the move could reduce production by about 20%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Fed has to create that sort of nervousness to help tip the inflation back down. Wage growth is strong, which is a good thing, but also strong means they have to slow it down to match otherwise we're going to have a wage inflation spiral. If that doesn't happen, then the Fed's going to have to go a lot higher. There's economists that think they should. But if they get it there, they can hold it there and let the system catch up to.
Wages stronger than anticipated on Friday. That was Brian Moynihan, Bank of America CEO, on CBS over the weekend. Euro-dollar, Tom, the move we've seen over the last couple of months, the dollar weakness that has kicked in. Euro-dollar has gone from a low at the end of September of 95.36 to 105.65.
Jordan Rochester publishing, many publishing on this moments ago, and Rochester of Nomura goes right to flows of the ginormous, he says, pouring in is the language, money pouring into European ETFs and of, I guess, equity markets.
So many people caught offside by the last couple of months. The China reopening, a part of this story, the fact that things in Europe aren't as bad as they otherwise might have been, given the energy situation and the milder weather. Winter's starting to kick in now, TK. We'll see how this progresses. And if we can repeat the act of getting storage levels up to the levels they were at going into this winter, next winter is the big question.
And I would really emphasize here that there's a war. And I think that so much of the ECB analysis on this side of the Atlantic negates, or lessens, I should say, this terrible war. Right now, a most interesting conversation with the most interesting guy in economic central banking today. Gabriel Makloff is with the Bank of Ireland. He is their governor. And can you imagine, folks in America, if basically the Federal Reserve System to find a new chairman went out and did a worldwide search? That's what the Bank of Ireland did with some controversy. The British economist of type moving from New Zealand to Ireland, and we're thrilled that the governor could join us this morning. Governor, what is the biggest challenge that Christine Lagarde has just in the coming 90 days?
Well, Christine, and thank you for having me, firstly, thank you for describing me as the most interesting person, but that's for a separate discussion. I think Christine and all the members of the Governing Council are facing the sorts of challenges that I think many people across Europe, if not the world, are facing, which is dealing with some extreme uncertainty. Well, I know we've been talking about that for a while, but the combination of the recovery from the pandemic, the supply chain problems that we've had, the news about China that I've just heard you talk about, the ongoing Russian war in Ukraine, and so on, we have a constellation of issues that we have to navigate through to arrive at the right monetary policy for the euro area. So it's a challenge.
Governor, one of the great challenges, and I would note Ireland's leadership in growth for whatever reason is debatable, but the fact is it's been a growth engine, everything said and done. Governor, one of the distinctions here is a belief in the strength, the technology, the nominal GDP of America versus a lesser nominal GDP in Europe. Do you push against that? Do you say we underestimate the potential of European growth forward?
I absolutely do. I think the potential there is huge. It's already a very, very big economy, and it's ambitious for itself. So I think, and technology is going to be a critical platform for the future. You know, digitalization, climate change, and demography are the big economic transitions that we're all going through right now. And I think Europe has the potential to be at the head of all of those, actually.
Let's talk about the reality of the decision, Governor, that you face on December 15th. Can I just start with your base case? Does it include a recession in the Eurozone economy now?
I haven't seen the ECB staff's forecasts, which we're going to see next week. But my own view is that we're likely to see the euro area in a technical recession. I suspect that Q4 this year, the one that we're in now, will see a very slightly negative GDP number, and we're likely to see that for Q1 next year. On the other hand, my expectation is we're not going to see 2023 as a year of recession.
Governor, with that in mind, how does that influence your view of how much tightening we ultimately need?
Well, in my view, we started the normalization of interest rates. People have forgotten that back in June we were in negative rate territory, and we're definitely not there now. But I also think that next week when we meet, I think a 50 basis point increase is the sort of floor that we should be discussing. I expect us to go there, but I don't expect us to end there. I do expect us to continue in future meetings.
Have you got an idea, Governor, of how far you would push that?
I was about to say, how far... how far I will push that will very much depend on the data and seeing what the projections are telling us, seeing what the latest data are telling us. But I think in my view, it's pretty clear that with inflation running at 10%, our target at 2%, core inflation at 5%, I think it's pretty clear that next week's decision won't be the last increase that we make.
Interest rate policy, only one part of this, of course. We've also got to talk about the unwind of the balance sheet. Can you update us on how discussions are going, how your thoughts are evolving on what we should be doing with a balance sheet that large of the ECB, and how you would prefer to unwind it?
I mean, well, firstly, my preference is to unwind it. I think the reasons for having it in the first place, the very long period of low rates and the risk of deflation, those reasons are gone. So we now need to look to unwind it. My view is that it needs to be done cautiously and carefully and predictably. So my preference would be for us to start slowly, leave ourselves the room for accelerating if we feel it's warranted, but to do it in that order. I expect us to set out or to agree at the next week's meeting a set of principles which the president will, for winding the balance sheet down, which the president will announce. I don't expect anything to start until next year. My own preference would be something towards the end of Q1, beginning of Q2.
Right. Governor, so important here is your experience in New Zealand, where there's been a real idea of rules of the road in central banking. I think they've provided decades of leadership on that. Olivier Blanchard and others are talking about a set above 2% in America. Combine your New Zealand experience with the idea that we may not bring inflation down to the comfort level, the anchored level of decades of theory. Can we live in America or in Europe with a higher inflation set? Let's use America as an example of near 3%. Can we live with that? Can there be a permanence to that?
Well, at the ECB, we had a review of our strategy like the Fed did before us, and which we concluded in July 21, and we concluded that 2% inflation should be the target that we focus on and aim for. There's been no discussion within the Governing Council as to whether or not that target should be changed, and I don't expect it to. That should remain our focus. On the other hand, I am interested in the debates that academics and others are having, and it's interesting to observe. Part of this is about, in my view anyway, part of this is about communication. So in New Zealand, the target was actually a range between 1% to 3%, with the midpoint being so it's about how you communicate and then explain what you're doing.
Right.
But for the moment, the ECB is absolutely focused on 2% in the medium term.
Is England communicating in the World Cup?
I think the English team have got an excellent chance to win the World Cup. One of the challenges you mentioned, Christine Lagarde has to maneuver over the coming weeks is making sure that all the members of the Governing Council who are supporting different teams can be managed appropriately.
I'm not sure how your Irish colleagues might feel
What scarf does Madame Lagarde wear here? I mean, what is the signal that we're going to see into December 18th?
I imagine there might be some French pride going on there, Tom.
There might be some French pride there.
Governor, wonderful to catch up with you, sir. Let's do this again soon. Governor McAuliffe there of the Bank of Ireland.
I'd like to do this in Dublin. I mean, I've been saying this for years.
Why is there always a trip involved with you?
It's just, I don't know. You know, I've been trying to get.
Go on then. Favorite bar in Dublin? What is it?
Well, I don't know. I think
I'm sure you must have a favorite.
Yeah, the Tour of Guinness.
The Tour of Guinness.
Yeah, that's my
great,
favorite.
great pint of Guinness. You ever had a pint of Guinness in Ireland, in Dublin? Just something else.
I don't have a life. I've never been.
You've never been to Dublin?
No.
Oh, we've got to change that.
No, I just work.
We've got to change that.
That was wonderful with the governor.
Live from New York City, futures lower by a third of 1%. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting. But that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Rates are going to continue to rise. They're going to rise throughout next year.
Recession is our base case. That's going to mean more cuts will happen in 24.
The Fed is going to keep at it until the labor market cracks.
We need to see that wage growth come down.
What matters is a wage price spiral.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What do you make of the Bramo long weekend? It's a new thing.
Stretching it, yeah.
She's going to a 4-day week.
Yeah, she's in the 4 days of work.
She told me on Saturday that she's too important to work Mondays.
Well,
and that she was just doing Tuesday through Friday for the rest of the year.
And we're sort of all doing this into the weekend. I think, time off at the end of the year, like a lot of people. It's been an exhausting year.
Hasn't it just?
It has just been...
It's been ridiculous.
Every month has been like the last 3 weeks of December. Like, can we get through this to the new year?
Let me do the welcome. Live from New York City this morning. Good morning, good morning. Alongside Tom Keene, I'm Jonathan Farrow. Futures right now down a third of 1% on the S&P 500. TK, the runway into year end. We've got CPI on the 13th. We've got the Federal Reserve on the 14th. The ECB, if you're interested, on the 15th.
And I'm hearing that this week doesn't matter. This Monday doesn't matter, John. I don't buy it. Into those two important meetings, I've got a bond market moving, and it's screaming the accommodation that the chairman doesn't want. The Bloomberg Financial Conditions Index is negative 0.483. That's going the wrong way for Chairman Powell.
So why was he so silent about it last week? Explain that to me.
Hopium. I like that word.
The difference between the news conference where he was just so direct and blunt about an equity market. Tom, he was basically told, and we talked about this, he was led to believe the equity market was up, rallying off the back of what he was saying in that news conference. And what did he deliver? What many people called the hawkish hits of Chairman Powell, the greatest hawkish hits. And then last week with Brookings, nothing, nada.
Market straight up, and you mentioned this at the top of the last hour. The zeitgeist over the weekend is just really as simple as you can say. People confounded by the resiliency of this bull market, sort of bull market, quasi bull market. I'll let Mike Wilson.
Stuart Kaiser of Citi called it stubbornly positive sentiment.
Yeah, I like that.
The idea that stocks were down just a tenth of 1% and yields were up by a handful of basis points on a 2-year off the back of a blowout jobs number, stronger wage growth. I was expecting more than that.
Well, yeah, I do agree that the wage growth focus seems to be where people most are. It's not labor participation. It's not the unemployment rate. And, we'll talk about this later. Steve Roach to be with us in the 8 o'clock hour. There it was, Jeff Rosenberg talking. We'll have the video for you later, folks. The wage price. That's a mark. When Jeff Rosenberg said that, one of our best guests said the language from the 60s.
We'll get our teeth into that in just a moment. Here's a sense of the price action. I'll whip through it. Equities are negative by a third of 1%. Your 10-year yield in America, a 10-year Treasury, shaping up as follows, up 2 or 3 basis points on a 10-year right now. So where are we, Tom? 351.33. Euro dollar having a little look at 106. 105.70 right now on euro dollar. That's a turnaround again, Tom. That currency pair firmer by a third of 1%.
Talk about the hope of it, I would say, in the zeitgeist of the last 30 days is, hello, international shows up correlated to that weaker dollar. I have no opinion on this, folks, about does international finally light it up, but it's within the literature over the weekend.
Thomas Kennedy's about to light it up. Chief Investment Strategist at JP Morgan Global Wealth Management. Tom, also to catch up with you. Can we start there with Chairman Powell last week? Where was the pushback that we were all looking for?
Yeah, I think it was surprising in that sense too, John. Good morning. The conversation from him was basically the same that we had at the press conference, except to the point. He did not push back on the easing in conditions that have happened since then. We're with this conversation at JP Morgan. We don't see the reason for him to get off that financial conditions merry-go-round, if you will. However, conditions have been tight for about 9 months, and we are seeing evidence in the economy so far. It's going to take time. But the most interest rate sensitive sector of America, housing, by the way that we will look at it and form a framework around it, is in a recession already. You have new home starts down 30%. You have home prices in America already going down. It will just take time. But if we're right and this conversation continues into the meeting in the middle of the month, he'll have to push back, and it raises the probability that he has to hike more than what's in the price.
Your TK's favorite word, pivot, hates it. 3-part story. First part is you decelerate. You go from 75 to 50. Second part is you pause. Third part you cut. Where's the pause? Where's the second part of that story?
Yeah, in our outlook, we have them pausing somewhere in Q1, being purposefully humble there. But the pause is close, and the question becomes why. It's not necessarily that conditions haven't moved. It's that you are going to see the impact on the real economy. And again, never in history have you seen housing go into a recession and the rest of the economy not follow suit. I think we have to take some anchors, knowing that this cycle is quite different, though.
Is wealth management, and good morning, Greg Fleming, who frankly invented all this for people. I want to look back. You guys always look forward. You got 55 pages out with a view, and I'll get to that in a moment. I think it's brilliantly done. But the bottom, John and I, our view forward is off a cocktail napkin at a bar. You guys got 55 glorious pages here. How did you guys do this year in the worst bond market ever? Bloomberg total return negative 17%, with a bounce still negative 12% right now. How did JP Morgan Wealth Management handle day to day this bond collapse?
Yeah, 2022. Tom, to your point, a generational tightening in conditions. I like to use that word. It closes the gap between someone like my father, who was in this business 30 years ago. This is a type of pain that hasn't been felt for a long time.
What are you laughing about?
I'm just smiling.
But the setup, Tom, to your point, how did we do? We experienced a painful year like the rest of Wall Street. However, we've been defensive in our posture since about April, and
since April.
That has proved us well. And I'm being humble there. We had to pivot as well. The demand-led inflation conversation shifted.
You nail. Folks, they got a committee of like 45. Is Jamie Dimon in on the meetings of this? Does he show up and say, hey, I want to put my 2 cents in?
He's invited every time.
Every time. There you go. That's the correct answer. Weaker growth, stronger markets. That's a conundrum our listeners and viewers face right now. Weaker growth, they get it. How do you have stronger markets if you have weaker growth?
The tightening in financial conditions is the market moving ahead of the economy. And this is a historical phenomenon that every statistician on Wall Street will talk to you about. When does the bond market, when do rates peak? Somewhere around the last interest rate hike. Are we close? We think we are. I think it's actually quite likely that 10-year rates have peaked already. The next point becomes, you become forward-looking and you move through this economic pain quite quickly. I think there's a lot of challenges to the equity market, but you can find places in the equity market where you're already priced to a recession. Small, mid-cap equities are already there. It's not suggesting they won't see price pressure in the event of a recession, but they should outperform.
You picked up on the pain. The reason for the pain in 2022 is not just that equities dropped, it's that bonds didn't rally. They dropped too. They were part of it. They were the epicenter of what was happening in equities. Yep. You said we've seen the highs on a 10-year yield at, say, 4.3%, was it? A number of months ago. We're at 350 right now. What is it that you see that drives yields lower from here and not higher?
Yeah, it's the economic pain. I mean, the market has priced and will be the cause of economic pain most likely in the year ahead. And our base case is for a recession. Everyone will be out questioning how deep and severe that will be. The merits of a financial crisis aren't there for us, given the lack of leverage, but the economic pain will follow, and markets will be able to respond on a go-forward basis.
And we'll get a more intuitive correlation between risk and bonds?
Yeah, I
get
think
that inverse correlation back?
When you look at bonds, bonds are back, and across your whole platform, people are talking about it. You have a triple threat there. You have yields that are rivaling historical equity returns. That's just in core bonds. You got a price appreciation possibilities. The IG index trades at 89 cents. For the last 15 years, you had bond prices at 105. You have price appreciation potential. And the best part about that, Tom, to your point, our clients are underinvested in this asset class. And for a generational wealth aggregator, equity-like returns with less risk, that's my job, overly simplified.
You worked with Dudley at the New York Fed, and you're one of these geeks that actually, he sits at home, and reads like 6 papers a weekend. I find the quality of the young Turks at the Fed right now just off the chart. There was a great housing article out of Dallas and that. What are you reading from the young Turks of your Federal Reserve system as they question where we are right now? What is it, housing that has your interest, or is it another angle?
I think there's a couple there, Tom. It's housing for sure. It's also the resiliency of the consumer. For much of the year, excess savings.
Can we agree that's the missed call this year?
The resiliency?
Yeah.
Without a doubt. I think you see that in payrolls too.
Yeah.
The resiliency of the consumer on the spending side, though, certainly ties to the wage market. But this excess savings conversation, from our perspective, it's starting to run out. On the bottom 50% of America, by the way that we'll break down the data, you're 3 months away from exhausting that excess savings.
Right.
Sure enough, you're seeing credit card spend go up. So turning to the pivot point, I'm looking for, as you say, Tom, my geeks to help me understand that. Maybe I'm talking to myself there. And then the last part is just the duration of tightening conditions to move through the economy. Right. It takes time. It doesn't mean it won't happen.
Okay, you're Lafayette, then you go on to American, I believe it was, and the bottom line is you were weaned on 60-40 or 60-30-10. That's the meat and potatoes of a private bank racket. What's it do in 2023? How far do you get off 60-30-10?
I think you can start to de-risk this conversation even further than 60-30-10.
What does that mean? It sounds like America's World Cup. You're going to de-risk the conversation?
Yes.
What, you landed an airplane? What do you mean?
Bonds are back. You have to start every conversation with a client and a wealth aggregator talking about bonds. Again, underinvested. Then you can move into the 10, the alternatives piece, Tom, to your point. We want to focus on where can we find security, where can we find stability. The pandemic showed us vulnerabilities in supply chains. CapEx has to follow. Logistics, robotics, infrastructure, and then also security. Food, energy from the war in Ukraine, showing some vulnerabilities there. Follow the CapEx.
Are you going to apologize to the good people in the New York Fed for calling them all geeks?
No, they're great. This goes back to Erica.
I don't know if Thomas considers himself a geek, Tom.
I remember a paper that Erica Goshen did 20 years ago.
Who's the geek here?
Fed.
I mean, seriously.
And no, come on. This is really important stuff. I don't have the material in front of me, but Dallas Fed did a definitive article on housing a couple days ago, a couple weeks ago, I should say. That's really important. And you're the one that lived this with Dudley. You were the wonk that had to keep track of all this stuff. For the flow. I don't know. The de-risk thing or that. What I know is we got a plan out to the middle of January, and then we got a plan, John. We're going to pivot there and go out here. I've never seen
for
this.
23 drives me nuts. Do you think that the New York Fed misses Dudley? That's the controversial question. Just silence.
That was so rude.
Silence.
I wouldn't have expected anything else.
Thomas Kennedy, you don't have to answer that. JP Morgan Global Wealth Management. Good to see you. Equity futures down 1/3%.
You can't get offset
on the
fast
S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. OPEC and its allies have decided to keep oil production unchanged. The outcome of Sunday's brief online meeting reflects the unpredictability of supply and demand in coming months. OPEC Plus has just implemented the 2 million barrel a day reduction agreed at its last gathering. Meanwhile, European Union sanctions on crude exports from Russia come into effect today. Authorities in China appear to be shifting away from the strict COVID-0 policy. Over the weekend, testing requirements were eased in a number of major cities. The loosening of restrictions comes as China enters downsizing in its latest outbreak curve. Fewer than 30,000 COVID cases were reported Sunday. That's the lowest level in almost 2 weeks. In the UK, the Rail Workers Union has rejected an offer aimed at ending a strike action planned before Christmas. Workers would have received 4% pay hikes this year and next, but the RMT union says that was conditional on a number of changes, including job losses, reducing staff on board trains, and closing all ticket offices. And the Crown Prince of Saudi Arabia reportedly will be one of the investors in Credit Suisse's new investment bank. According to the Wall Street Journal, Mohammed bin Salman is considering an investment of around $500 million to back CS First Boston. Credit Suisse is spinning off its investment bank as part of a reorganization following scandals and huge losses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays. Tomorrow, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
The labor market is strong, and we're still in unprecedented territory in terms of the gap between vacancies and jobs. And I think that what that's got to tell you is that we got a long way to go to getting inflation down where the Fed has said that it wants it to be.
Rebalancing the labour market is a big effort. Larry Summers there, the former US Treasury Secretary, on that topic. Right now, equity futures down 0.4% on the S&P 500 as we kick off a brand new trading week this Monday morning. Yields are higher by a couple of basis points, just north of 350 on a 10-year. Crude right now, Tom, $82.13. We're positive there by 2.7%.
A lot of discussion about OPEC Plus, which is OPEC Plus, I guess Russia and Northern Macedonia is in there somewhere.
Why'd you have to do that?
I just have to bring it up.
Why'd you have to keep bringing that up?
Just because, you know, I mean, the U.S. is out of it now. It's sort of equal.
No, it's just rude.
Okay.
It's not fair, Tom. I'm still bruised by that.
You're bruised.
Upset, yeah. Emotional.
Well, but look,
the fact that I'm watching a World Cup
Giroud
without
from AC Milan, I mean, you can just, you know, he's doing, the guy for France is doing well.
Yeah, he's doing all right.
He's doing okay. Okay, there's our World Cup talk. What we know is there's been a lot of talk about oil, but the price hasn't moved. Julian Lee joins us from our shockingly competent hydrocarbons team in London for a brief here into Kevin Book. Julian Lee, I want to just bracket the price right now. If I'm in Riyadh and I'm a functionary for the elites who have to figure out what to do with oil, bracket from 80 whatever dollars, bracket from $88 Brent, what's too cheap for Saudi Arabia? And where does it get to a good price for them? What's that bracket look like today?
I think that bracket is movable, and I think they want what they can get without tipping the world too far away from oil, either in the short term or in the longer term. Clearly, they would like prices closer to $100 a barrel than they would to, say, $75, $80 a barrel. But look, even this kind of a price level, given that Saudi Arabia is producing almost as much as it has ever produced, this kind of price level is not bad for them. Their income from this is looking pretty healthy.
Julian, how will they respond to China reopening? And what are you expecting from the meeting between Xi and leadership in Riyadh?
Well, I think that you know, clearly a Chinese reopening is very good for oil producers. It's undoubtedly going to have a positive impact on demand. Just how positive that is, I think, will depend very much on how quickly China reopens, how quickly industry gets back to normal, how quickly people start traveling as they were before the pandemic, and that may still be some time away. It's also going to depend, I think, very much on the overseas demand for Chinese manufactured goods. It doesn't help so much if China recovers and the rest of the world doesn't, because you know we're not going to be buying the stuff that the Chinese industry is making. So I think it's sort of part of a healthier picture for producers, but it's not the whole deal, I think. Looking ahead, I mean, Saudi Arabia, other Middle Eastern producers have come under increasing pressure in the Chinese market from discounted Russian barrels that are trying to find a new home after being shunned by Europe. So we may see attempts to try and strengthen that relationship in terms of oil sales from Saudi Arabia into China, perhaps Chinese investment in the opposite direction.
Hey, Julian, wonderful, as always. Julian Lee there out of London. TK, I think this is the conversation right now, how this oil market responds to a China reopening.
I totally agree. 100%
what OPEC Plus does
100,
in the meantime.
I'm going to go back. I mentioned this as we get to Kevin Book here quickly. Jay Pulaski's conversation with you, I'm going to push it now 10 months ago, 11 months ago. Sure. Yes, it's delayed, but it's still hugely germane.
Well, it's the debate right now into 23, that's for sure.
I agree. It's the debate, and it is the factor in oil. To find if that is correct, maybe I'm wrong, Kevin Book joins, no one will be the first time, head of research at Clearview Energy Partners as well. Kevin, how does China fit into your 2023 hydrocarbon calculus?
I think the price goes up if demand goes up is an easy one. But there's other questions too, including the export of Chinese middle distillate fuels to a world that could be short diesel. Right now, the Chinese refiners are back in the market. They're sending out diesel again. That could be a big balancing factor when Russian diesel potentially gets impaired, not with today's embargo, not with today's price cap, but with a price cap that rolls in on products from Russia on February 5th.
What is the state of distillates on the East Coast, in New England, as Stephen Shork, among others, has mentioned? But what is the state of distillates in America that Clearview sees?
Well, right now we're less short than we were in the Northeast, but still quite short. From the perspective of government planners, this is alarming because it's not just transportation fuels that are at risk, but home heating fuels and backup power generation from distillate as well. In terms of the refiners running flat out, they have been, but of course, you have a big hole that could be coming right now, and the rest of the world that used to necessarily use less diesel from the U.S. because they could get it from Russia will now be bidding for the same barrels that could come out from the Gulf Coast.
How does it link into the debate over the Strategic Petroleum Reserve? Take us away from the political debate of that and give us the actual, almost micro theory that it means for the price of a barrel of oil or a gallon of gas.
Well, ledgering reserves over from government stockpiles into the market means you're essentially adding supply that wasn't there before. It's almost like magic, except that there's limits to how far it can go. And there's questions about whether or not it displaces existing investment. You do it enough times, and we did it a lot of times this year, Tom, over the last 12 months or a little bit less. We've been doing about 225 million barrels of strategic sales and exchanges from our reserve alone. That could crowd out investment and have a long-term deleterious effect on supply.
Do you see investment coming on? I mean, it was a debate at 100, 110 Brent, and now we're 20% under that, 15% under that. Why invest?
Well, that's a question for the companies. But if you look at their performance, rig count relative to price, the slope of the rig count rise compared to the price rise, much flatter than coming out of the trough from 2014 to 2016. So substantially flatter, like 2/3 of the slope, despite a much steeper price.
Do you see how Kevin booked his calculus there on a Monday? I mean
well,
that's what he's
on the spot.
Just, rate of change of the slope.
And nailing it all the time.
Yeah.
Kevin, thank you, sir. This was brilliant. Kevin Book there of Clearview Energy Partners. We're catching up with Senator Cassidy of Louisiana in about 20 minutes' time.
He's one of my favorite people.
We're going to talk to him about some of this.
Yeah, he's not like I mean, with respect to his public service, he's different than most politicians, which is really cool.
You mean it doesn't sound like a politician?
Oh, he's like a physician, and he's actually done like serious research and had a day job before, he began doing it. And
is the investment story done when it comes to the oil patch in America, Tom? Is there anything Congress can do to change the trajectory of things?
No, I stood with one of our secretaries of energy the day one of our public policies went down to voting defeat. They were literally in tears. They were so angry. And the answer is there isn't an American oil policy. We were saved by technology. Not nobody. Phil Verliger, good morning. We didn't see as a general statement the shale revolution coming. That was all technology. Technology gave us the comfort we live now, particularly versus Europe.
You remember the conversation of peak oil? Or was it 20 years ago?
Don't get me going. That was
peak
like
20 years ago.
Pivot has replaced peak oil.
People have forgotten that. Do you remember that? Peak oil.
Yes, I lived it. Yeah.
People have forgotten that. Do you remember that? Peak oil.
I lived it. Yes.